Huawei, China's top chip maker, have built an advanced processor to power its latest smartphone. It's a sign that Beijing is making early progress in a nationwide push to overcome U.S. sanctions. Huawei has been at the center of intensifying U.S. trade curbs on Chinese businesses, which Washington says are based on national security concerns. Let's speak now to Bloomberg's Peter Elstrom, who has details here. So, Peter, strip this story down for us if you could. Bloomberg worked with a specialist research firm on this to take apart this new phone, this new smartphone from Huawei. What did the investigators find?
That's right. So Huawei quietly dropped this phone last week into the market, and it caused quite a stir. It's an advanced phone. It's called the Mate 60, but there were a lot of questions about exactly what kind of technology was inside the phone. Huawei had to back out of the smartphone market because it didn't have access to the most advanced chips, the kind that would power, say, the iPhone, for example. So it wasn't clear exactly where it got these chips or how it got these chips. Unlike most technology companies that love to talk about specs, Huawei didn't say anything about the specs here, especially the key ones. So what we did is we bought one of the phones, and then we worked with this firm, Tech Insights, which does breakdowns, teardowns of products professionally. And they looked at the components inside the phone. And what they found was very, very interesting. They found that there is an advanced semiconductor inside the phone that's made by SMIC. That's a Chinese chip-making company that's not known to have these kinds of capabilities. They were able to make the phone at what's called 7-nanometer technology, which is quite advanced. And in that case, they were able to produce a processor that was much more advanced than people had anticipated SMIC was actually capable of doing. So it's a sign of China's progress in getting around some of these U.S. restrictions on the kind of technology it has access to, particularly for a company like Huawei, which is blacklisted by the U.S. government.
Yes, I was going to ask, so why does the speed of the chips inside this Huawei phone, why does it matter? And you've given us a bit on that already. It signifies then that China is moving faster than the rest of the world had anticipated in moving to these faster chips. Is that the basics of the story?
That's right. That's right. The U.S., you'll recall that last year the Biden administration imposed export controls on China. And it was trying to draw a line in the sand where China would not have access to chips that were more sophisticated than 14 nanometer, which is about 7 years beyond the latest cutting-edge technology. And now China has shown that actually internally in China it can make these 7-nanometer chips, which are only about 5 years behind the latest technology. So it's a step forward. There's much that we don't know about this chip. We don't know what kind of volumes Huawei and SMIC can make together of these chips. We don't know whether they can make them at a cost that's competitive on a global market. But it is a sign that they're able to make some progress in this area that's been so contentious. And is something where the U.S. has tried to limit their ability to kind of delve into these kinds of technologies in the future.
Yeah, and really interesting, Peter, that they dropped this phone so quietly then, given the obvious interest in that subject. So will this affect the geopolitical clash then between Beijing and Washington? If Beijing is moving faster on its own than anticipated, does that limit the effectiveness of the Washington sanctions?
Well, it certainly is going to get the attention of the U.S., the Biden administration, and particularly the Commerce Department, which has been at the forefront of trying to impose these restrictions. It's a sign that the sanctions that they have in place right now may not be as effective as they thought they had been in the past. It seems like they are making some progress here. Inside of China, state media picked this up right away, and they kind of trumpeted the accomplishments. I think they're trying to show that they feel like they can make progress in technology, and semiconductors in particular, even without the support of the United States or even with these U.S. sanctions, which are very, very severe.
I'm head chef at the Mariah, an unbelievable cultural oasis. People from all over the world get to experience fine dining, arts, and events here. And it's my home, a reflection of Saudi's culture and beauty.
With Barclays, every change leads to a bold possibility. You have the vision, we have the insights, financial solutions, and global perspectives to help you make it real. Barclays Corporate and Investment Bank, powering possible.
China is trying to build a chip maker to rival the world's best, and Huawei's latest phone has become a symbol of that. We sacrificed the Mate 60 Pro in the name of science and found out it's powered by the best made-in-China chip yet. Building the silicon at 7 nanometers while subject to US sanctions shows just how far Huawei and China's top chip maker SMIC can go without outside help. The mystery isn't over, as we still need to know if these chips can be manufactured in large volumes and at reasonable cost. But for now at least, China has scored a big publicity win, if nothing else.
India, home to a now record 1.4 billion people, more than half under the age of 30. But that also includes the largest number of jobless youth anywhere in the world. The fastest growing large economy in the world, India has the third highest number of billionaires. But on per capita income, it ranks at the bottom. The widening gap between the richest 10% and the bottom 50% makes India one of the most unequal countries in the world. Democratic English-speaking India, with an army of software engineers, has sought to become a major economy since its economic liberalization in the 90s. But authoritarian China has made bolder moves to become 5 times bigger. So why might this be India's moment? One big reason: it isn't China. Policy making from Beijing nowadays remains hard to predict. Western countries are wary of China's growing economic and technological clout. International companies are seeking supply chain diversification, China plus one. To speed that along, India's government is spending record amounts on infrastructure and offering production incentives to key industries. Other reforms range from a unified national sales tax to a world-leading digital payments system. Bullish investors and stock market highs have burnished the India story in the year of its G20 presidency. That Prime Minister Narendra Modi hopes will set the stage for his re-election next year. It will also test whether most Indians are buying the India shining story or not.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Tuesday, September 5th. Here are the top market stories that we're following for you at this hour. The problem with stocks. Morgan Stanley's Mike Wilson says there's too much optimism priced into the equity market and breadth is still weak. And the problem with autos. Hurt by a weak China, more competition, and a potential worker strike in the U.S. We're going to see what it will take for the stocks to shift gears. And the problem with oil. Russia, Saudis extend oil cuts to the end of the year. Brent tops 90 for the first time since November. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, it's been a pleasure. I love the tan. You look great. It's so nice to see you back. We missed you.
So I'm back from Greece, where it is now raining, and it is now very hot in London. So I feel I'm doing something right now.
Good for you. And you made it on vacation through the strikes, through the delays.
Precisely. I think the story with strikes around the auto sector and the strikes around what is happening with the airline sector, I think they're kind of in some ways synonymous. These are industries that have pushed back really hard on their staff over a number of years, and maybe they're now paying the price for that. We've got some data coming in. Let's talk about that as well. We're going into quiet periods for the Fed at the end of this week. We've got the ECB coming up next week. The numbers really matter right now. Factory orders out of the States come in negative 2.1. That's slightly better than anticipated. Ex-transport, they come in better than anticipated, actually. In durable goods, negative 5.2. That's bang in line with expectations. Ex-transport, they come in at 0.4. So, Alex, the numbers look all right. Certainly the durable goods numbers kind of are bang in line. They could have been worse. The factory orders numbers look all right as well. I think the market's not going to react too much to these kinds of numbers. The oil story, though, is a different matter. I think this is going to really start creeping into the inflation data. And I think a lot of people have been talking about the fact that inflation is just going to come down sequentially. I think with higher oil prices and higher for longer oil prices, that may be now being called into question.
Yeah, and then you wrap in potential strikes in many different industries, right? And then are you looking at then wage pressures being filtered through, and that's a higher for longer inflation expectation environment as well. I mean, oil at 90 isn't good. And I got to say, for the administration here in the U.S., there's literally nothing that they can do. They got nothing to combat this.
No, I guess you could continue to maybe take some oil out of the SPR. Maybe you go back to that, but that feels like it's been a bit of a busted flush. There's not much there's not much, and there's not as much there to do on that front. So yeah, no, I think it's going to be interesting, but I think it's going to be something that around the world people are going to pay attention to. I have to say, filled up the car the other day, definite sticker shock in terms of where prices are. They are high. And that takes us to our question of the day, which you alluded to at the top of the day as well. What is happening with the auto sector right now? I think it's an interesting story post-Labor Day. We need to be talking about that strike story. We need to be talking about what is happening with the energy story as well and what that's going to mean. European autos are having a really tough time. You've got the auto show taking place in Munich. You've got the German Chancellor, Olaf Scholz, the pirate as they're calling him now. We'll talk about that in the next hour as well, saying that they shouldn't be afraid, the Europeans, of the Asians. But this is a sector that can't get into gear. Let's talk about it. Craig Trudell joining us on the auto side. Nur Al-Ali of Bloomberg M Live joining us as well. Craig, I'm going to start with you. The European car makers, they're facing a challenge from China. They've got Chinese data that is slowing down. The US automakers have got a more immediate kind of threat that they need to deal with, this strike issue. Let's talk about post-Labor Day. Let's talk about how big a threat that actually is.
Yeah, I think with GM, Ford, and Stellantis, they have had the luxury of the last, maybe call it 6 months of being able to produce like they were accustomed to prior to the pandemic. And it really took that long for them to work their way through the semiconductor shortage. And so they've maybe been able to build up a bit of inventory. If anything, we've actually started to hear some overshooting, and maybe that will come in handy if we do have a walkout, I think.
Do you think we're going to have a strike?
I think the way the rhetoric is coming out of the mouths of the United Auto Workers Union, it feels like an inevitability at this point.
Okay, Nor, can you talk me through the potential downside here to some of the equities based on that? I mean, I appreciate that they've been raking in the profits the last few years, right? But still, they have to make this big shift from ICE to EVs profitably and then facing down a double-digit wage increase.
Yeah, absolutely. And that's partly why the Biden administration actually extended some funding to those automakers so they can actually, that can aid them in their EV transition. And, just mind you, these strikes, these labor talks are about those fears from those workers that are worried about their jobs, coming into that transition. So they are asking for those higher wages to come in as well. And that feeds into the wider story. And if you look actually to compare this, and this is an excellent analysis by some of my colleagues on the blog, you'll see that, in fact, automakers in the U.S. have actually underperformed discretionary stocks because there's just so much that's in the fray here. They've got higher production costs, obviously, relative to the Chinese that are taking up a much larger portion of the industry. And obviously, there's been a lot of concern as well. They're projected to increase their dominance of that industry, and they have lower costs there in China by about 25% as well.
No, the thing that I don't really understand is why would you want to own a US auto stock? I know they've had a good time recently, but they're going to have to pay the price for that now. When you can own Tesla, Tesla is clearly out there to make some market share. Tesla is cutting prices, it's coming out with new brands, it doesn't have the legacy issue. Why would you want to own a U.S. auto company when you can own Tesla?
Why wouldn't you, right? I mean, there's a lot of diversification involved here, right? So automakers in the U.S. currently, you know, they are legacy companies, but they have also performed relatively, I would say, well. So if you look at some analysis through the port function, you'll see, for instance, that Ford and, for instance, General Motors, you know, really underperformed relative to total returns, relative to the total index. So potentially there is some appeal here. If they were to weather those, those strikes in the short term, there's potentially some appeal here in terms of valuations. And there's a lot of optimism currently baked into the U.S. stock market. And this is another issue here. Of course, a lot, you know, there's almost shifting gears here. Larger voices in the market are now pointing to a softer landing in the U.S. And so that's going to point to, you know, better manufacturing. And where would you go? You'd go to those automakers that you typically know.
Yeah, you know what hurts manufacturing costs, though? Higher oil prices. And Guy, this is where I feel like everything is interconnecting with us today. Because on the one hand, you have potentially higher wages, you have issues there, then you have higher oil prices, and all of that winds up feeding into potentially inflation scenario. And it also points to sort of the messiness of the transition that the whole world's going to be underway as we go to green, right? If
absolutely, but you've got to also
messy,
point
that's more expensive.
They do, but you do wonder whether that messiness, whether that inflationary impulse is being aided and abetted by Joe Biden's Inflation Reduction Act. That is something. You look at what the UAW are saying. They're in the driver's seat, to excuse the pun, right now. Biden has basically said, you need to build these cars in the United States. They're like, great, fantastic. That's going to be good for our staff. We're going to make sure that they benefit from that as well. Craig, isn't that the issue here? Joe Biden's basically set a trap for himself.
Yeah, I think it's tricky because, you know, you have a situation where a lot of the battery plants that are going in the U.S. As a result of the IRA are going down in the South. The UAW has had a heck of a time, as we know, for decades now, organizing plants that they haven't already represented. So, you know, what sort of, you know, what can they sort of bring to the table to convince what are in the end joint venture companies, you know, GM, Ford, Stellantis, they have joint ventures with foreign companies who have very little interest in seeing their labor costs go up. What can they do to sort of, you know, bring these companies to the table and convince them that, you know what, unionization is a good idea here when we know that, you know, the Hyundais of the world, Toyotas, not to mention Tesla, you know, are not going to, you know, be organized anytime soon. The UAW has had a weak hand to play for some time.
So this leads also to the question, Noor, is the market in general underestimating higher yields, wrapping it all in?
Yeah, absolutely. And I think that's a big part of it. We've been talking on MLive about how inflation really is about to resurge. And we're seeing different aspects of it really narrate itself in different facets. You talked about oil. You know, that's led by, you know, Saudi Arabia, Russia extending their production cuts. Surprisingly, Saudi Arabia, till the end of the year, they were expected to extend them by 1 month. You know, these rising yields potentially point to the Fed, if not, not raising rates anymore, at the very least, keeping those tightening efforts on for much longer than the market anticipates. You look at money markets and they're expecting Fed to start cutting sometime within the next year. And that's not really translating into the different aspects of the economy. If you're looking at commodities, they're resurging. You're seeing a lot of concerns here, and that's translating to some complacency, particularly in the U.S. stock market.
Such a fun way to set the conversation, guys. Really appreciate it. Craig Trudell of Bloomberg and Noor Ali of Bloomberg MLive. Thank you very much. So coming up, more insight into the question of the day. Why is the auto sector running on empty? And then we're going to lead that into the inflation and yield conversation with Subhadra Rajappa, SocGen head of U.S. rate strategy, joins us next. And as we head to break, let's hear what Acting Labor Secretary Julie Su said about the impending auto strike. I spoke with her last Friday after the jobs report.
We remain hopeful that the parties will resolve their issues. We trust their process to do that. Obviously, you know, strike is a part of that too, and everybody would love to see a path forward where the union and the employers do the right thing. You know, these are a moment in which union members are seeing historic profits coming out from a pandemic. So I think that the parties have to remain talking.
This situation is really scary for a number of reasons. First, you have a very, very activist new UAW leader who has said very, very inflammatory things that is just beyond the pale in terms of any auto company's ability to meet it.
That was Steve Ratner, Willett Advisors Chair and CEO, talking to Wall Street Week's David Weston on the UAW strike. Remember that Ratner led the bailout of the U.S. auto industry during the crisis in 2008, 2009. So that brings us to the question of the day. Why is the auto sector running on empty? Joining us now to discuss is Subhadra Rajappa, SocGen head of U.S. rates strategy. Subhadra, I know that you're a rates person, not a car analyst, but I feel like all of these stories sort of intersect, right? You have the potential recessionary fears if you wind up having a full strike. On the other hand, 42%, 46% increase in wages, that's a wage inflationary scenario, and higher oil prices. How do you wrap all that into your thinking about the bond market?
It's very difficult, Alex, because this is a moving target. We've had several strikes, UPS and others. We've had, issues with the trucking company. So it's really, really hard to gauge what the labor dynamics are going to be over the longer run. We know that wages have been high and sticky. We haven't really seen a precipitous rise in wages. But broadly speaking, a combination of both higher oil prices as well as pressure on the labor markets, a very tight labor force, is going to continue to put some pressure on inflation. Yep. That's kind of where we're trying to gauge how much of an impact this is all going to have on the rates markets.
Subhadra, good morning. It's Guy. The savings are coming down pretty sharply in the U.S. Spending has held up as that money has been spent. What kind of a wage story are we going to need to see to keep the consumer on track, do you think?
So it's, wages are running, between 4 and 4.5%. It's kind of stayed there. We haven't really seen an uptick. I mean, it's clear that, labor has a lot more bargaining power. They've been able to, win a lot of the concessions and higher wages in some of these negotiations. But broadly speaking, if you look at, the broader spectrum, you are seeing the economy, different parts of the economy perform differently, as you mentioned. The savings rate is coming down. The consumer is coming under a lot of pressure. Student loan moratoriums are going to end at the end of this month. We've seen a splurge in the summer. Is that summer splurge going to last? Unlikely, given the fact that savings rates are low and the consumer is coming under a decent amount of pressure going into the fall.
So with all of that in mind, how do you know what's fair value in the bond market? What should the 10-year be trading at, and how should you then invest?
No, we're definitely recalibrating our expectation for where 10-year yield is going to end at the end of the year. Fair value for 10s is anywhere between 4 to 4.25. I think that given how strong the economy has been, how resilient the consumers have been in the face of higher interest rates, and the Fed is also committed to keeping policy on hold for longer at these very high levels. I think that that's going to keep interest rates at a much higher range than we had anticipated coming into this year.
Okay, let's talk about what's happening at the front end, Subhadra. If the Fed's done, and there's reasonable evidence to suggest that may be the case, if the Fed's done, is the 2-year great value right now? If you've got money in a money market account, you're getting 5%, do you switch into the 2-year, or do you switch further out? Do you go for more duration?
So the 2 years still has, a tremendous amount of value. I think that the Fed could perhaps deliver another 25 basis point hike. It's not going to happen at the September meeting, perhaps at the November meeting. But that basically tells you that 2-year yields are at or close to the peak levels. So, and for the curve, we're looking at perhaps either the two-cents part of the curve steepening out one way or the other. So for the most part, at least over the near term, it looks to me like the value is going to be in the 2-year, because the 2-year is going to be pegged to Fed expectations. And there's potential perhaps that the 10-year part of the yield curve could rise further. But over the longer run, if we do expect a recession in 2024, yields across the curve are going to be quite attractive on an outright basis, as well as a diversification, given the fact that risky assets are going to come under pressure as we head into a recession.
So Subhadra, you said that for fair value for the 10-year, you're looking at 4 to 4.25. And we're right at 4.25 now. So if your recession view takes hold for next year, do you need to then buy the 10-year and just sit tight?
Perhaps it's a question of timing. I mean, if you looked at the first half of the year, you went long 10-year yields. You probably did very well during the regional banking crisis when 10-year yields got down all the way down to 330. Now we're back again near the high end of the range. Could we push higher? Perhaps. Over the very long run, I think yields are probably going to head lower, and this might be one of your better buying opportunities for the longer run.
Subhadra, always great to catch up. Really appreciate the insight as ever. Thank you very much indeed. Subhadra Rajappa, SocJet's head of US rate strategy. Manchester United stock is being pummeled right now. I think it was a Daily Mail, Mail on Sunday article yesterday talking about the fact that Glaziers might want to keep it. Stock's under real pressure. Okay, still ahead. What are we going to talk about? So we're going to talk about chips. Huawei's latest smartphone succeeds despite US sanctions. They're making some breakthroughs in China. Looks like they're actually managing to sidestep the US sanctions. We'll talk about it next. This is the teardown story. It's definitely worth watching. This is Bloomberg.
It is 21 past 7 on the West Coast. We want to get to the startup. We cover the top tech stories from the Bay Area and beyond. In Silicon Valley starts its, I think it looks nice morning. Bloomberg Technology co-host Ed Ludlow joins us now. All right, let's get to Huawei for a second. So they had built an advanced 7-nanometer processor to power its latest smartphone. Yes. And this is significant because this is kind of a slap in the face to the U.S. Look, we don't need you. We can do this on our own.
Yeah, the way we're describing it in layman's terms is this is the best or most powerful made-in-China chip or smartphone chip. It's in the Huawei Mate 60 Pro, which you'll remember was released stealthily last week. And what Bloomberg did is we went to a research firm called Tech Insights, and we said, here is a handset of the Mate 60 Pro. Tear it down for us and see what you find. Lots of emphasis on the processor. So what we know is that it was made on a 7-nanometer node. That's 2 generations removed from the cutting edge, which is 3 nanometer. But there had been speculation last week when this handset hit the market that it was 5 nanometer. And that was a big surprise because the market and industry for semis broadly says, well, to the best of our knowledge, China has not yet got to 5 nanometer. So all this confirms is it is 7 nanometer. It's made by Semi Manufacturing International, or SMIC, which is China's sort of best and biggest chip maker. But they're still not where we are in the United States. The question is any of this caught by sanctions?
Okay, so what's the answer to that question? And is the gap between what is being produced in the United States and what is being produced in China growing or shrinking?
The answer is we don't know because we asked the US Commerce Department that question and they haven't responded. But one thing about SMIC, or Semiconductor Manufacturing International Corp, is that so much of their supply chain is related to and bound by the US technology curbs. Are they shrinking? Is the gap between China and the US shrinking? No, not on this basis. And there are some limitations, right? Jefferies has a note out looking at what we've said, looking at this Mate 60 Pro. The handset sold out within hours. What that tells us is they probably had very small inventory. Mm-hmm. So they're not just 2 generations behind in chip making in terms of 7-nanometer node versus 3 nanometer, but they're not able to produce it at volume.
Hey, can we turn to NVIDIA for a second? Ed, since we have you, Rob Arnott is the Research Affiliates founder, right? And he had an interesting chat with Bloomberg and talked about how NVIDIA could definitely wind up being in a bubble that's too big to fail, but too big to succeed. And quote a textbook story of big market delusion. What did you make of this?
I mean, Rob Arnott is known to us as the bubble hunter. That's how he made his name at Research Affiliates, LLC. And his point's really simple. The run-up in the stock and its current valuation is us pricing in all of the capex that's going to accelerated computing and the compute needed to train large language models. The run-up is extreme, and so this has all the hallmarks based on his experience of a bubble, and no one else has seen it yet.
Goldman Sachs differs.
Yeah, so Peter Oppenheimer, strategist crew, has a note out saying, AI valuations are high, but they are not extreme, quote. And you know, his logic is this, that because the run-up is not outside the bounds of what they consider at Goldman to be extreme, the inference they're drawing is that we're really early in this cycle of hyperscalers and others committing capex to develop compute for AI and other large language models, and that we will continue to see that expansion and investment, which will continue to push up valuations even higher from where they are currently.
All right.
Okay.
Yeah.
I think we've got it. It could be a bubble. Wow. It might not be a bubble. Who knows at this point?
Time will tell. Time will tell.
I think it's one of those things. It's like recessions, isn't it? You can only tell them retrospectively.
I've not lived through or worked through a bubble. If there is one, it will be my first bubble, and I'm looking forward to it either way.
Something to look forward to, Ed. They are certainly, having lived through a few, they are certainly entertaining. Let me put it that way. The run up to 2000, I remember it. I remember being in a bar in the Berkeley Hotel, and this technology analyst just kind of ranting in my ear about how the world was being changed, and this stuff was going to the moon, and the valuations were crazy, but actually could be justified.
That's where you got the grey hair. You got to get the grey hair.
But I don't get to go to the bar this time, which is disappointing. It's the Blue Bar in the Berkeley. It was lovely. Yeah.
Excellent.
Ed, you can have that experience. You should go to a really nice bar, and I'm sure it'll be populated with those kinds of people. Ed Ludlow, thank you very much indeed.
I will.
Alex, I just want to take a quick look. Ed might want to chime on this one as well. Manchester United stock being absolutely pummeled right now. I think there was an article in the Mail on Sunday yesterday talking about the fact that Glazers may not want to sell. This is what it's doing to the stock. This is a 2-day share price drop, as you can see.
Yeah.
The move is substantial. Alex doesn't want to talk about sports.
No,
this is not. This is M&A. This is not sports.
Yeah, but it's valuation.
Anyway, we're going to get back to the auto sector in just a moment. This is Bloomberg.
We're about an hour into U.S. trading session. We're finally back from Labor Day. Guys back from vacation. Stocks trading a little heavy, though. Simone is tracking some of those moves. Simone?
Yeah, shares in the red to start the second day of this month's trading sessions in the United States. We're expecting a pretty negative September if the past 30 years of history, though, is any indication. Over the past 30 years, we've averaged down negative 0.7% for the month of September. And certainly today's vibe, very much in line with that. The VIX up, shares down. We're watching WeWork here. The company completed a 1-for-40 reverse stock split late last week. So this is the first day it's trading after that split was completed. Of course, this company under a lot of pressure, whether or not it can continue as a going concern, something that has been raised recently. We're seeing shares there fall after that stock split, though. But the major story of the trading session so far has been what's happened in the oil markets. And if we flip up the board, we'll see. The expectation was that we would see Saudi Arabia continue to extend its voluntary production cuts, at least through the month of October. But the country coming out and saying it will extend them through December, Russia coming out saying it will extend its export cuts through the end of the year as well. And that's why we're seeing so much interest on the longer dated derivatives. Those in the blue, those are for November. The ones in the white here are for October. And so that's where we're looking at this reaction as we see Brent crude past $90 a barrel for the first time since last November. And this is, of course, having an impact on some of the big energy names, despite some negative headlines out. For example, Chevron had been fearing the impact of some of those strikes that could potentially happen in Australia, but shares up there over 1.3%. Shares of Exxon, ConocoPhillips, all well in the green. And the S&P Energy Index was, last I checked, the only sector of the S&P that's actually eking out gains today. Alex, Sky.
Simone. Thank you very much indeed. I want to get back and talk more about what's happening in the car sector. Mercedes-Benz is taking on Tesla, unveiling an EV which has got a longer range, get this, than any Tesla model currently on the market. Bloomberg spoke with Mercedes-Benz CEO at the IAA Auto Show yesterday.
Our goal is value over volume. So we're not pushing volume. We're very, very careful about how we go to market, our go-to-market strategy. And as you can see from the results for the first 6 months of this year, that has been working quite well for us. We're focused on value for the customer. I don't think the customer expects from a Mercedes a little bit of a roller coaster ride, but something that you can depend on. So we will continue with the value over volume strategy.
Value over volume. It has certainly been working. That has been the strategy that has basically come out of the chip shortage. Takes us back to our question today. That was Ola Hallinus, of course. Why is the auto sector running on empty? You look at the stocks here in Europe, they are super cheap. You look at what is happening in the US, looks like the market kind of doesn't want to buy this sector in advance of potential UAW auto strikes that could be happening really soon. Tom Narayan, I can't believe I can't say that. Global auto analyst at RBC Capital Markets. I've said that name about 1,000 times, and now it doesn't seem to work in my mouth. I think it may be a vacation brain issue. Tom, I'm really sorry about that. Deepest apologies. You can blame a vacation. The US story, I think, is really fascinating right now. You've got this potential strike coming up. The market's kind of looking really wary around what could happen here. Is this one of these situations where you want to buy the stock now, kind of in the expectation that this strike gets sorted out, or do you want to wait? And if you do wait, how big a pop could we see?
Yeah, I think there could be a very sizable pop here. The issue, though, is it's kind of a chicken and egg thing, right? So if the investor base is waiting for a resolution, that means that it could get worse before it gets better, right? There's going to be a lot of negative headlines in the news around this, right? It's a political gamesmanship of two sides. So do you wait until things get worse and then buy at a better entry point? Or do you just buy now knowing that when this is all resolved, the stocks will move higher? I could see both sides of the argument. Frankly, I think you also have to be choosy a little. I think a name like GM is really well positioned in the U.S. because they take advantage of the IRA on EVs. They have a huge set of launches. Yeah. You could just buy that name now and then take advantage of it later.
Hey, Tom, my question is, though, what do their operating margins look like in the future? Like, yes, I understand the subsidies for EVs. I understand the $12 billion to build EV factories here in the U.S. But then if you look at higher wages or maybe pension reform or 32-hour work weeks, I mean, that is a productivity labor hit for sure.
Yeah, that's no doubt about that. And, everybody's looking at 2019, even ourselves at the last strike, what happened. And what happened was you had higher labor costs. But that got offset by the pandemic, which allowed these car companies to juice up pricing, right? So if pricing falls, price mix falls, that could be a problem because then higher wages don't get masked enough. One caveat I will say, Ford has this on their website. They show the labor costs as a percentage of their total COGS. The impact actually surprisingly isn't as big as some people are fearing. Maybe it's like 100 basis points or 50 to 100 basis points of margin hit, which is nothing to laugh at. But it's not something like a doomsday scenario. It's really more like the cherry on top of price mix coming down that could make things worse. But ultimately, the thing that people are most scared about is price mix coming down, not really wage inflation related to UAW.
Tom, are US automakers more insulated than European automakers to the threat that China poses? The IRA kind of has a whole range of issues built into it that promote US manufactured vehicles. The Chinese clearly are building a lot of EVs right now, and they're doing it cheaply and they're doing it efficiently. Where is the biggest hit going to come? Is it with European automakers from that Chinese threat, or was it US automakers?
Absolutely, European automakers. Yeah, I mean, and you have to ask yourself, why isn't there a European IRA? Some people say it's because the German OEMs are really exposed to China and dependent on China, and they don't want to anger the Chinese. Other people say it's politicians in Europe who are just, don't like the auto industry. I don't know. But in the US, we do know that they're more insulated against Chinese OEMs coming in. In Europe, it is a tough sell. One thing I will say is I think the premium guys in Europe will do better. BMWs and Mercedes. Brand is really important in Europe, as we all know. Mass market guys, there's a reason why Stellantis and Renault have been talking about being more protectionist against the Chinese OEM. So I think mass market folks are going to be more threatened by this threat, and maybe the premium guys less so.
Well, and Guy, to your point, it's just the carrot stick thing. Like the way it's been described is that the U.S. just throws money at the problem first, asks questions later, and Europe asks all the questions, and that may be because that's how the European Commission, European Union is set up. But that poses a lot of issues when you're trying to move quickly.
Well, the problem is that there's two different. Tom, there's two different car sectors in Europe. As you say, you've got the mass market guys. I remember talking to Sergio Marchionne. And he said that the biggest error the Europeans ever made was letting the Koreans come in, Kia, etc. And it completely undermined their market. And you do wonder whether, in order to protect the high-end guys who are working really well in China, in some ways the Europeans are throwing the mass market guys under the bus. And that could be the threat here. What do you think?
I think you're absolutely nailed it. The one thing I will say is, I lived in Europe for 4 years when I was a European analyst. You don't see a lot of Japanese OEMs. You do see them in the US. So there is a brand kind of loyalty in Europe. When you go to Italy, you see Fiat. When you go to France, you see Peugeots and Renaults, right? So I do think there is some brand loyalty. But look, the Chinese BEVs are very competitive. I think they're going to be a formidable threat. Mm-hmm. Are they just going to displace the Japanese or maybe the Koreans? Maybe that happens. But make no mistake. Yeah, these governments need to figure out what exactly they're going to do if they want to protect their native auto industry or just let them suffer a tough consequence.
Or just talk tough. All right, Tom. Hey, we really appreciate it. Great stuff. Tom Narayan, Global Autos Analyst at RBC Capital Markets. A great entree into our next conversation because we're going to take a look at how you de-risk funding the energy transition, which is something the auto industry is in the middle of right now as well. Barclays Global Co-Head of Sustainable and Impact Investment Banking will be joining us next. Stay tuned for that. This is Bloomberg.
Public finance will not suffice. This is true for Europe, but it is also true for emerging market and developing economies. Private capital will need to be mobilized at scale. And here, green bonds are widely recognized as providing part of the solution. This is why we just put forward a new proposal to attract private investment. It's called Global Green Bonds Initiative. So we are ready to share our expertise with your teams on how to develop your own green bond markets. And at the same time, we will push on the investor side. Together with the European Investment Bank and our member states, we are allocating 1 billion euros to de-risk private investments.
That was European Commission President Ursula von der Leyen. She was speaking at the Africa Climate Summit in Kenya. And that all revolves around how to fund the energy transition. You got older, profitable industries winding down and newer, riskier, high capex industries ramping up. Just take a look at what's happening with EVs in the auto space. So joining us now is Marie Freire, Barclays Global Co-Head of Sustainable Impact Investment Banking, who literally is the person to help bridge this gap. Marie, wonderful to see you in person.
And you, thanks.
Okay, so you just heard Ursula von der Leyen lay out kind of her plan. How are you guys trying to mobilize private capital and de-risk right now?
Absolutely. And I think part of the aspect she was talking about was the private side and the climate tech side, right? So really the new companies that are bringing solutions, whether that's technology, really, but also now increasingly asset-heavy business models who need to be scaled up so that their costs can come down and they can be deployed in those legacy companies that we were referring to. And so they can really think about how do we decarbonize our businesses? Back to business practice is really now the nitty-gritty of enacting the decarbonization journey.
How wide is that gap right now?
Right. And so I think there's a very specific gap, if I can build on what you're saying, and it's between companies that used to be more software-based, more licensing-type business models, and now companies that actually are building these assets, right? So these are CapEx-heavy industries. It's not like Silicon Valley where you're thinking about adding users to a software platform.
It's like a wind turbine.
It's a wind turbine. You're building real stuff.
A pipe infrastructure,
right? Exactly. So energy storage facilities or hydrogen businesses, etc. And now where does the capital step in? And so one issue is around private equity capital. And so when you roll off that growth equity, but pre-infra, right, pre-infrastructure investments, that's where I personally see a gap. And it's really exciting to see some initial funds, also sovereign wealth funds, looking to step in and bring private equity expertise and infrastructure investment expertise together to bridge that gap.
Marie, good morning. It's Guy.
Hey.
How should I think about what these stocks are? Are green stocks growth stocks? Doesn't sound like it. How should I, if you would put a kind of wrapper around them, what would it be? How should I think about them?
Companies, yes, so most of them are private, right? Definitely growth companies, I think that's right. But I think we're going from growth into scaling, right? And that's a slightly different issue. And so the issue here is often, we've got the technology, is it fully de-risked? Maybe. But especially in the current market environment, what people really want to know is fully tech de-risked, but also the commercial risk is becoming more of an issue. And that's where really the scaling piece comes in, and seeing how can we get the investment community comfortable with that, and how do we unlock new pockets of capital?
Higher rates.
Yes.
Do they hurt this case? The higher they go, the more you got to de-risk.
It has become more challenging. I think that's fair to say. So for these companies to raise private equity capital in particular in the last 18 months has become more challenging. For a lot of these investment firms, they've become much more selective in where they want to step in. As we already said, tech risk is definitely something they're less comfortable with than maybe they used to be. So what are the consequences? Private raises are taking longer, 9 months plus, maybe. They also want to see revenue generation earlier on, if not already today. And even from a profitability perspective, there used to be a lot more patience, say 18, 24 months out. That's fine in a business plan. Right now, ideally, they want to see that today, or at least a very clear path to that much nearer term.
Who do you think are going to be the ultimate investors into this space? Where is the money going to come from?
I think what President von der Leyen was saying was right. Like, we need to sort of solve this together, right? So there's definitely private equity, venture capital in the earlier stage. Sovereign wealth and pension funds are definitely also keen to get heavily involved. But the concept we've touched on a few times, how do we de-risk it in order to have a wider pool of investors be able to deploy, right? Who have certain requirements when it comes to risk return versus their end investors. And that's where I think we need help, potentially from government, but also sectors like the insurance sector can step in and help disaggregate that risk.
So because if you take a look at, say, the traditional stuff, like you have the automakers we talked about in terms of transitioning to EVs and how great, thanks for the subsidies, but then there's these other problems that come with it. Ørsted, for example, so it's great to build these wind turbines, but we're kind of seeing what happens at the other end of the cycle, right? You can even go back to Solyndra, which I'm sure no one wants to talk about, from like a decade ago. And are we going to be in this space? Like, is that going to kind of dent insurers' capabilities, dent their ability to de-risk?
I think it's, again, fair to say that in the last 18 months, some investors have had some challenging situations, right? And again,
that's a nice way of saying it.
Nice way of saying it. And again, that's sort of adding to the challenges we're already facing given the rates environment. I would also, sorry.
Yes. Is it going to make it more difficult for the insurers to de-risk because of it?
Forgive me. And so, yes, there will be failures, right? Not all business models will work out. Not all technologies will work out. But if we go back to the problem statement of how do we decarbonize the global economic system, we know that this is going to be a puzzle with many pieces and many things that we'll need to explore, and pathways we'll need to try to go down before we know the ultimate, what that ultimate coming together of different solutions will be. Sorry, Guy.
Okay, let's take the wind turbine industry, because we've been talking about it. Has this industry moved too fast? There hasn't been, the industry itself has not been robust enough. It's tried to move too fast, it's tried to scale too fast, it's tried to build bigger and bigger wind turbines too fast. Is there an element at the moment that the industry just needs to settle down and actually build in some redundancy, build in some robustness into the mechanics of how this whole thing works, so that there are fewer surprises? And once you get fewer surprises, is it going to make it easier for long-term, more patient capital to get involved?
I think you're really touching on a very important piece, which is the evolution. But have they moved too fast? I mean, arguably, given where we need to be in terms of our net zero pathway, we're still moving too slowly, right, at a global level. So I'm not sure that we can step back in terms of the urgency with which we need to deploy these technologies and solutions at scale. But indeed, I think there'll be different pockets and different owners that are appropriate at different points of the evolution of these various sectors and technologies. And certain will have higher risk appetite. They'll be expecting different return profiles early on, needless to say. And then as these technologies and solutions mature, hopefully with as few hiccups as possible, there'll be different correct owners or appropriate owners given the risk and return profile of those assets further down the maturity curve.
And then hence the insurers to try and help offset later investment and broader investors. Marie, thanks a lot. Really appreciate it. Marie Freire of Barclays joining us there. And keep it here, because Bloomberg's going to have coverage of the Barclays CEO Energy Power Conference, which is why Marie is here and not in the UK. That's coming up tomorrow, so stay with us for that. And coming up right now, SoftBank's ARM is seeking a downsized IPO, still expected to be the biggest listing of the year. We're going to have more details in today's Wall Street Beat. This is Bloomberg. now for Wall Street Beat. We take a look at what's buzzing on Wall Street and the world of banking and finance. And today we're taking a look at ARM, ramping up for the biggest IPO of the year. Joining us now, Bloomberg's Sonali Basak. But a downsized IPO.
Downsized significantly. Yeah. If you think about it, there was a point in time where earlier this year we were talking about ARM looking to raise as much as $10 billion. Now, the marketed range at the top end would bring them in $4.87 billion, still over $4 billion, even at the low end of the marketed range. Now, at a valuation perspective, you're looking at a firm now valued potentially at about $50 billion or more, almost $55 billion at the top end of that range. How does that compare? Remember, SoftBank a month ago or just a couple weeks ago really, had bought back its share from the Vision Fund that it didn't own, and that valued the transaction at $64 billion for ARM. So this is significantly below that price. It is above the price that they agreed to sell ARM to NVIDIA for. But also, what's interesting about finally having these numbers as well, and Bloomberg Story points this out today as well, the interesting part about this is that from a price to earnings perspective, this is still over 100 times its trailing earnings for the last 12 months. Yeah. And if you compare that to Synopsys and Cadence Designs and other companies that are trading in the U.S. of the like, those companies trade below 100 times their earnings. So,
Sonali, this was meant to open the door to other IPOs. If this is what is happening here, what does that tell us about the other IPOs that could be following in its wake?
It doesn't necessarily mean that the door would be closed, but remember, the door was only open for a little bit longer. If you talk to EquityZen, for example, they think that's about a 3-week span where you really have to file if you're going to get moving this year. We have CPI next week. You have global growth concerns. You have all of these things that are factoring into the market that make a listing kind of challenging in this market. But if you don't do it now, then when? And Instacart has already taken a down round. So their valuation adjustment has already come to the fore, plus finally some profitability. The lack of supply makes it an intriguing buy for investors, but it is choppier out there than it looks.
So to this point, are we seeing a lot of issuance come on right now, like it's happening in the IPO market, but in the investment grade and high yield market?
It's definitely worth talking about the IPO market relative to the debt markets, because there is a little more success in the debt markets. And if you take a look at the way that junk debt has been trading, riskier debt, even leveraged loans, there's some safety there that has given the investors in those deals some confidence in investing in new deals, plus that hung debt being taken off the pipeline for the big banks. So what does that look like? It means for high grade sales, about 16 companies. This is a very highly read story on the terminal today, about to kick off U.S. high grade bond sales, but then another 15 billion or so worth of leveraged loans expected this month. And that does not include some highly anticipated deals such as Rorark and Subway, which would add another 5 billion to the pie. So certainly a very interesting amount of issuance ahead. Remember, we were talking about CPI and those global growth concerns. Getting ahead of any potential future problems, including CPI, including potential higher interest rates, is the name of the game when you look at some of the issuances hitting the market today and tomorrow.
It's fascinating, isn't it, just to see what happens here and all those forces coming together. Sonali, great stuff as ever. Sonali Basak joining us on what is going to be a busy week for those guys selling those bonds, guys and girls. What is happening in the market right now? European stocks down by around 0.2%, but the sector that really stands out today is the energy sector. It's up by 0.8%. The Saudis and the Russians are going to continue pushing their reduced crude output through to the end of the year. That's been announced today. Prices go up. It's not that sticky, this move that we're seeing, but we've been up through 90. And the energy sector on both sides of the Atlantic is definitely benefiting from that. Talking of that yield story, look, what is happening with German bonds continuing to push high. It's been interesting since payrolls that we have seen this coming through. Ursula Marchioni, BlackRock EMEA Head of Markets and Portfolio Solutions, joining us next. This is Bloomberg.
I'm head chef at the Mariah, an unbelievable cultural oasis. People from all over the world get to experience fine dining, arts, and events here. And it's my home, a reflection of Saudi's culture and beauty.
The kind of slowing that you're expecting into year end for some really phenomenal numbers we're seeing in the third quarter.
Yeah, well, certainly consumption has been the standout this year. The consumer's been very strong, and that's pretty aberrant from historical hiking cycles. You do tend to see more moderation in consumption as labor markets slow. We're just really not seeing that. Consumption in the third quarter looks like it's running above 2.5. Obviously, GDP tracking reports also look like they're closer to 3. So this is an economy that just doesn't seem to want to quit. Now, nevertheless, though, we are seeing indicators, higher frequency indicators that would suggest that things are slowing. So we have student loan repayments that are starting. Treasury daily data suggests that people are actually prepaying that. And at the same time, they're spending less. So high frequency data from credit cards suggests that we are seeing consumers that are starting to pull back. Add to that, that you have seen much less credit creation overall for the economy this year, and that is a recipe for slowing. Now whether it actually pulls us into a recession or not, I think that's more of a question mark here, just because of the ongoing resilience in the U.S. economy.
Well, do you see us on a path towards returning inflation to 2%? Are you confident we're on that path, Tiffany?
Yeah, well, we're certainly going to get some good news on the inflation front in the back half of this year. But really, that good news is centered around some of the pandemic-related effects just fading. Of course, things in China have been much weaker than expected. They are, as a result, exporting some disinflation. That's going to help U.S. retail goods prices going into the holiday season, which many consumers will be happy about. But nevertheless, other measures of inflation, wages, for example, in the United States, they still look sticky. This super core measure that the Fed loves, services ex shelter within the PCE inflation measure, also still looks relatively elevated. So one of the things that we've been noting, and this is consistent with the Fed's forecast, is that you do need to see some labor market cooling in order to get that down. And I think it's a question on whether we'll see some labor market cooling just because the economy's been so strong.
That's the labor market, throw in housing as well. Tiffany, we could look at commodities too. Can I just get a comment, Tiffany, potentially from you on whether this commodity market move complicates the Fed's effort with Brent, WTI back in and around $90 a barrel?
Yeah, well, certainly, headline inflation matters. It matters for how consumers think about future inflation and inflation expectations. But on the other side of that, it also matters because higher gas prices will affect consumers' ability to spend on other discretionary items. So it's a little bit of a mixed bag in terms of how it affects the economy. We still, in terms of the underlying inflationary pressures, we like to look at core inflation. And again, that's going to look a lot better in the second half of this year, with some risk, though, that maybe it reaccelerates if the economy doesn't cool.
So, Tiffany, when we get forecasts next out from the Federal Reserve, how do you think they'll compare to the last set of forecasts we got earlier this summer?
Yeah, so they're going to be a bit of a mixed bag in terms of their implications for the rate path. So we do think Federal Reserve officials will have to revise down their core PCE inflation forecast, at least for the end of this year. But at the same time, they're probably going to be revising up their growth forecasts. And there's been some good news on the labor market front. They could have to revise down their unemployment rate forecast. So all of that, sort of suggests, maybe they keep that rate hike in the back half of this year, maybe they don't, but this is coming up in September. We would also argue there's a lot more data between now and the end of this year for them to think about. And I guess overall, just looking out to 2024, if the economy is not cooling, if we are still running at above trend growth, if the labor market, the unemployment rate is still at these levels, kind of 3.5 to 3.8, it's possible the Fed might even have to do more. So I think that's something that that we're grappling with. Not our base case, certainly, but
sure.
Something that's a risk that's out there.
Well, let's take it one step further. Let's play what if for 2024. Tiffany, are you still of the opinion that, let's say inflation is 2 point something, that they won't be willing to do anything about it? They won't be willing to crush the economy or the labour market. They'll just tolerate 2 point something.
Yeah, certainly. I think if it's a 2 handle, that's probably good for the Fed. But I do think there's questions around if the labor market remains this tight. It could stay around 3, which is a little bit more cuspy. Yeah, but overall, I think there is a question around if you get it down to 2.5, let's say, and you continue to forecast it moving lower over the next few years. then maybe that is all you need to do, and that would be very similar to what the Fed did in the 90s with their opportunistic disinflationary strategy. And I would say if you look at economic performance in the 90s, it was pretty good, and overall 2 is really not. It's not a magic number, if you will. I mean, it's 2% inflation. That there's not a lot of cost benefit analysis around 2 versus 3 versus price stability in terms of their target. Nevertheless, though, as Chair Powell said, they're probably not going to change their inflation target, but they could alter their strategy within that target, to let it go a little bit above for a period of time.
What are you most worried about when you wake up every day and look at the stock market and the economy?
I feel that the economy, and particularly the stock market, is very secondary to a list of important long-term problems that we have that no one takes seriously enough yet. And I feel that when we sit here discussing the stock market, we're a little like Emperor Nero fiddling while Rome burns. My job description these days at GMO is working on long-term underrated problems. And it's been a wonderful time to be doing that because we have climate change, the most important issue in the investing world for the next few decades. We have shortages of resources. We have shortages of manpower, a population bust the like of which we have never seen, particularly in a few countries like China, with huge significance. We have an incredible growth in inequality, which I think is the poison in the political system. And we have a great surge of toxicity. I think we've made our planet unfavorable to life in every form, including Homo sapiens. And these are real issues. They're moving incredibly fast. They threaten the well-being of Homo sapiens. They threaten perhaps the existence of a stable global society.
You are well known in the investment world for saying that sometimes there are bubbles and bubbles should be avoided. Do you think we're in a major bubble now, right now in the United States? And do you think that the tech bubble has burst sufficiently so that the tech bubble burst is over?
I think we are descending from the 2021 bubble, which was one of the great bubbles. And this should be normally the deflationary period, the deflating period. Which is a function of will the earnings decline, will profit margins decline, will the economy go into recession, and we will have a recession running perhaps deep into next year, and an accompanying decline in stock prices.
So the recession that you're predicting is probably not going to happen in 2023, but maybe...
It may start in 2023.
The Federal Reserve recently said that they think we've cleared the recession hurdle, and they don't really project a recession any longer.
Right.
You disagree with the Fed on that?
Yeah, I think the Fed's record on these things is wonderful. It's almost guaranteed to be wrong. They have never called a recession, and particularly not the ones following the great bubbles.
I'm John Ehrlichman. Welcome to Bloomberg Markets.
And I'm Matt Miller. Let's get a quick check on what's going on in the markets at this hour. The S&P 500 is down just about 1/3% right now, trading at 4,500 even. You do have the U.S. 10-year yield moving a little bit higher, well, a decent amount higher, 8 basis points right now, 425.78 as investors sell those bonds. The dollar index moving higher by about 0.6%, 1252, 1253, the level on the U.S. dollar index. So continuing to climb higher and higher. And that is the case as well for crude oil. This is Brent crude, the global benchmark, $90.32. But NYMEX is up as well, over $86 a barrel. So real strength in the oil market today after we heard that the Russians and the Saudis are going to continue the production cuts they put into place at least through the end of the year. Also, just in the last few minutes, we learned that United Airlines has issued a nationwide ground stop for all flights due to a computer issue. This is according to ABC News, and they cite the FAA and United for this nationwide grounding of all United flights. As you can see, the shares are now down to session lows, off about 4.6% at 47.41. John?
Well, that is certainly a mover we'll continue to watch. Matt, you were also talking about the energy trade today and that commitment from some OPEC Plus nations to supply cuts that has fueled energy stocks on a down day for most sectors. So a name like Occidental Petroleum up about 3.5% at this hour. As we continue to read through to the health of the economy, I thought America's Car Mart was an interesting example. Stocks down 14% right now. The used car dealer's profitability is taking a hit as it sets aside money for potential bad loans. They did have management change as well, but obviously the softness in the market is being evidenced, or I guess the credit jitters as well. We'll continue to watch that story. Matt, we're also watching some news about a couple of names coming to the S&P 500 later this month, including Airbnb, and investors like that news. Stocks up about 7%. And a big drop for Manchester United stock in U.S. trading, Matt, as reports have indicated the Glazer family changing course on a possible move in the team sale of the team just based on the offers that have been coming in. Anyway, investors trying to make sense of that with the shares losing about 1/5 of their value in trading today.
All right, fascinating story indeed, and one that's ongoing. Let's take a look now at the bigger economic picture. Markets are still watching every comment from the Fed and any data point that gives hint on the direction of the economy. Wall Street billionaire Jeremy Grantham spoke with Bloomberg Wealth's David Rubenstein recently, and he gave us his take on the chances of a recession.
I think we are descending from the 2021 bubble, which was one of the great bubbles. And this should be normally the deflationary period, the deflating period, which is a function of will the earnings decline, will profit margins decline, will the economy go into recession, and we will have a recession running perhaps deep into next year, and an accompanying decline in stock prices.
All right, well, let's get some more perspective. Kevin Nicholson joining us, Global Fixed Income Chief Investment Officer at Riverfront, which oversees nearly $9 billion in assets. And obviously right now, Kevin, everybody's trying to make sense of where the economy heads from here. What is your outlook?
John, my outlook for the economy through end of the year is going to be strong. And for us, we believe that we're not going to see a recession until late in the second half of 2024. We are of the opinion that the Fed has one more hike left in them, and that they're going to get to their terminal Fed funds rate that they put out in the dot plot several months ago of 5 5/8. And, you know, we think that the equity markets are going to be range bound, probably 4,400 to 4,600 in the near term. And the fixed income markets are going to be range bound as well. When we think about the 10-year Treasury, we're thinking that it's going to be range bound in the 315 to 335 area.
It's no surprise to hear that Jeremy Grantham is bearish and he thinks that we're coming out of a big bubble, because that's what he always says. But we did hear from Goldman Sachs, Kevin, that they're bringing their recession forecast down to 15%, which is pretty much nothing, because Jan Hatzius doesn't think they're going to be long and variable lags that will hit us down the line after the Fed has raised interest rates so far so fast. What's your view on that?
Matt, first of all, let me clarify. I think I said 315 on the 10-year. I meant 415 to 435. But I think that there are definitely going to be some long lags, and but I think that the economy is going to continue to progress forward. One of the things that you've seen thus far this year is that anyone who has been calling for a recession or especially an earnings recession, that has not panned out. And we're actually seeing earnings revisions upward. And so I think that from a recession probability standpoint, I would put the probability of a recession, especially within the next 6 to 12 months, probably around 10% at this juncture, in our view.
And as for the markets, Kevin, just looking at the S&P 500, we're entering this period now where September can be challenging. I would say since the start of June, the benchmark index has been within a 5 or 6% range. On the fixed income side, what's the strategy you've been using given the economic realities right now?
John, the strategy that we've used on the fixed income side is that we've been opportunistic as it pertains to adding duration to the portfolio. One of the things that we did not believe early on was that the Fed was going to cut rates anytime soon. So we have been pretty much underweight duration or short duration as it pertains to the aggregate all year. And when we look across our portfolios, we're about a year short duration. And the main reason for this is because when you look at the belly of the curve, especially in that 10-year part of the curve, we think that it's still too expensive. And so that's why we've been opportunistic in adding duration to the portfolio. So when, the long end, when the 30-year finally got over 4%, that was when we started thinking about adding duration to the portfolios.
What's the most exciting thing that we have to look forward, Kevin, over the next month? I mean, is it the dot plot? Are you watching out for the ECB? What's moving in your world in sort of doldrums of summer?
Well, I think the big thing that I'm focused on is a couple of things. Obviously, you're going to look at the dot plots when they come out. But I think I really am paying a really close attention to credit because our fixed income strategy has been that we have taken credit risk over interest rate risk for most of the year. And the credit markets continue to tighten. And that is interesting to me because that's basically giving an all clear to the markets. And so it's kind of flying in the face of the idea that a recession is near because of the inverted yield curve that we've had for over a year now. So I'm really paying close attention to that because when you look at the high yield market in particular, spreads are a lot tighter than the long-term average, but we're not seeing defaults tick up. And so that is a place that I'm really, really focused on, especially going into the last quarter of the year.
Yeah, absolutely key to see if companies and consumers start slipping in terms of making payments as the rates tick up and they need to refinance. Kevin, thanks so much for joining us. Riverfront Global Fixed Income CIO Kevin Nicholson giving us his take on the economy and the markets. I want to get back now to a breaking story. United Airlines has grounded aircraft nationwide due to an unspecified equipment outage, a computer problem, ABC says, according to the FAA's website. Bloomberg Intelligence senior airline analyst George Ferguson is on the phone. George, do you have any idea what this could be? And is it unique or not at all unusual?
So we haven't heard exactly what it is yet, right? But it sounds like it's a computer problem. Is it unique? No. We've seen airlines have problems with computers from time to time. I'd imagine this is a pretty busy day for United, so I'd be surprised if they're doing any sort of major computer change this morning or major computer handoff, for some sort of upgrade or something like that. But I guess we'll just watch it very closely, right? I mean, they have a ground stop they issued the middle of the day. That's bad, but it's only really, I think, important to financials if it cascades into multiple days of problems, which I wouldn't expect. I'd expect them to be all over this today.
All right. Well, we'll have to continue to watch to see how it all plays out. George, great to get your perspective on this developing story. George Ferguson, Bloomberg Intelligence senior airline analyst, on those United Airlines headlines. Time for a quick break. When we come back, between the Inflation Reduction Act subsidies, potential UAW strikes, and the electric vehicle price war, the auto outlook is evolving very quickly. We'll dive deeper next. This is Bloomberg.
Powering financial solutions that transform industries. Powering seamless execution in evolving markets. We deliver our entire global bank to power new possibilities for you. Barclays Corporate and Investment Bank, powering possible.
Roller coaster prices, supply chain glitches, political unease. They do their best to wreck my business plans. With so many unknowns, how do I know I'm making the right decisions? Aon helps me stay on top of things. They have expert points of view on volatility from around the world, paired with local insight that helps me get back on solid ground. Better decisions. Aon.
This is Bloomberg Markets. I'm John Open with Matt Miller. Time now for our Stock of the Hour segment. We're monitoring the auto sector, where recent headwinds for General Motors have pushed its stock into negative territory for the year. Strike worries circling the Detroit automakers just as they're trying to transition to electric vehicles. And beyond competing with Tesla, Matt, you've got UBS out with a note suggesting China's EV players will increasingly put pressure on some of the Western firms as well.
Yeah, all these issues front and center over the past few days. We've had the International Motor Show in Munich. Take a listen to some of the executives from the event.
We have to avoid entering a price battle in the short term. When you reduce and you start to get into discount and stuff like this, residual value go down. It's not good investment for the consumer.
Our goal is value over volume. So we're not pushing volume. We're very, very careful about how we go to market, our go-to-market strategy. And as you can see from the results for the first 6 months of this year, that has been working quite well for us.
We embrace competition. Let's embrace them, and let's try to have a fair and competition to build ever better products for our customers.
We've got a very good marketing performance in China. Europe is our strategic market, and we want to try. We want to communicate with the customer here, and let's see. The IAA is a great opportunity, and to have this conversation.
We are in the middle of the transformation, and it is about electrification, digitalization, connectivity, autonomous driving, and I think folks are prepared.
So those are all the overseas car makers, but the really interesting issue is the possibility of a strike, or that being averted here in the U.S. Bloomberg Detroit Bureau Chief David Welch is here to talk about, how detrimental this would be to the bottom line for GM, Ford, and Stellantis. David, how much more does the union want to raise its workers' pay?
Quite a bit. I mean, their initial ask was 46% from the U.S. car companies. Now, look, you can call that an opening bid, but considering they got 2-3% raises over 4 years last time, plus a couple of 4% lump sum bonuses, the bid ask here is pretty wide. So they want a lot of other goodies back. They want retiree benefits, which I don't think the companies will give in on that. It's what really played a big role in the Ford, or rather the GM and Chrysler bankruptcies over 10 years ago. They also want cost of living adjustments, which again is pay. I think they'll get nice raises. They're probably just not going to get 40%, but they're looking for an awful lot of money, Matt.
David, what about the stakes, considering these Detroit players are in the midst of this EV transition?
Everybody's on edge over this because you've got this very fiery union president who's made big demands. He's threatened to strike. And it's at a time when the companies are spending billions on electric vehicles. And I think even before the union rhetoric started, we're starting to see questions from the car companies and others about just how much electric vehicle demand is out there. So you've got billions being spent to develop these models, battery plants, the whole infrastructure, with sort of like, demand uncertain, and as a result, profits uncertain. GM doesn't think they'll make money on its EV program until 2025. Ford says they're going to lose $3.5 billion on the program they have now. So a lot of money being spent, none being made. In fact, losses piling up. And now you've got the union coming in a lot of ways justifiably asking for a raise. They really didn't get much of one over the past 4 years, even though the company's put out record profits. But if you're Mary Barra, if you're Jim Farley, if you're Carlos Tavares at Stellantis, you're looking at a lot of costs and potential losses from a lot of new models coming forward. And then you're going to have to add to your labor costs. It's not huge adds. I mean, this doesn't really erode their profits a lot, but when you have all this uncertainty going forward, it really makes CEOs and investors very nervous.
President Biden yesterday said he doesn't think there's going to be a strike, and he's the leader of the free world, David. So is that just presidential optimism, or does he know something that we don't?
Look, there's a chance he and his staff have been talking regularly with Sean Fain, the president of the UAW, but that's ultimately who's going to decide if there's a strike. Sean says it's the companies who will decide if there's a strike or not, but he's under a lot of pressure. He's a reform candidate who won the election in a runoff by a very narrow margin. He's got to deliver the goods, and he's been promising bringing back all kinds of benefits and pay that were given away in 2007, and the workers are getting enthusiastic about this. Now he has to get a deal ratified, so he's got to bring a big contract to them. And the companies, you look at Ford's initial offer, it was nowhere near 46% in pay. It was, I think, a quarter of that. So, there's a big gulf here that's got to be settled in the next 9 days with these companies, or somebody's going to walk out, and I think it's going to happen. He may have to do it just to prove to his membership that he's tough and that he's trying to get the best deal for them.
David, thanks very much. David Welch joining us from Detroit. Coming up, the outlook for General Electric from the CEO, Larry Culp, who spoke with David Weston. Next, this is Bloomberg.
Roller coaster prices, supply chain glitches, political unease. They do their best to wreck my business plans. With so many unknowns, how do I know I'm making the right decisions? Aon helps me stay on top of things. They have expert points of view on volatility from around the world, paired with local insight that helps me get back on solid ground. Better decisions. Aon.
There's a place where global markets are always open, where you can explore and discover innovative new offerings and hundreds of trading products right at your fingertips. That's CBOE, the exchange for the world stage.
Well, we are getting an update. According to the FAA, Matt, the United Airlines ground stop has been canceled. So we'll continue to track all of those United Airlines updates on the, obviously, computer issues that seem to be impacting the company's flights today.
Yeah, they had a computer problem. They turned it off, turned it back on again. Now it works, and the planes are back in the air. There's a lot of pressure on CEOs right now as economists continue to forecast a global economic downturn. Most. Bloomberg's David Weston spoke to GE Chairman and CEO Larry Culp on this week's Wall Street Week. Take a listen.
We couldn't be in a better position with respect to the post-pandemic recovery in aerospace. You've seen the performance thus far this year. We're really on a record pace. Given both the return to flight really around the world now as people get out and see places they haven't been to. And at the same time, they're looking to modernize and expand their fleets. So we have tremendous backlogs with our major airframers, Boeing, Airbus, for example. The supply chain challenges are significant, And right alongside everything we're doing on the commercial side, we've seen a really strong uptick in our defense business, as one would imagine, both with fixed wing and rotary. So in terms of how big this business can be, we're, I think, on a path where we could be growing in the mid-single digit, high single digit range for some time. That would put us well north of $40 billion in but a few years. Lot of opportunity. We have, I think, an enviable position in propulsion. But again, it's not about how big we get. It's about how strong we are. And are we serving our customers? Are we taking care of our team? Are we doing well by way of our shareholders?
As you say, Larry, you're not going to get ahead of the board of GE Aerospace when you get to wise not to do that. I'd say, what's on the table at this point? You've spent your 5 years really redoing the balance sheet, really fixing the cash flow situation, retiring a lot of debt. Capital allocation maybe hasn't been so much of an issue because you're just trying to retire that debt. Going forward, you may well have some capital to work with. So what are the possibilities, both in terms of acquisition but also sale, potentially?
Well, I think that we want to be wise stewards of that capital, right? I've long believed that investors give you a license to reinvest in your business, and you need to be careful with that license lest it gets pulled. But I think what we've tried to do is set up all three of the businesses to be in a position where they are well capitalized, investment grade, and will have the opportunities to think through not only their organic options, be it M&A, small, mid-size, probably not something large and headline-breaking. But at the same time, how do we think about buybacks? How do we think about dividends? So I think you'll see each of the three companies, once we spin GE Vernova sometime early next year, be in a position where they'll have tailored, balanced capital allocation policies that will be in effect. I'm confident all three boards will carry forward that responsibility well.
You mentioned Vernova. Let's turn to power.
Sure.
Renewables have been a challenge for just about everybody at this point, including for GE, although you think you're going to get toward profitability here before the spinoff, as I understand it.
Yes.
What are the challenges? What is the potential for profitability out of that renewables business?
Well, we've made a lot of progress, David, in our GE power businesses the last several years. That's really been, I think, ground zero with respect to the improvements that we have made in Vernova and GE at large. And we're really running the power playbook in our renewables businesses, principally in onshore wind, which is, I think, the battleground today. We think that can be a high single-digit operating margin business in time. Everything that we've talked about over the last 4 quarters in terms of the nature of that turnaround has really played out, both in terms of our field performance, our cost reduction efforts, and just the day-to-day rhythms in the business. I was with them just a couple of weeks ago, and I'm really encouraged by what we're seeing. The Inflation Reduction Act has driven a lot of demand, not only in our onshore and our offshore wind businesses, but also in our grid automation businesses.
And that was General Electric CEO and Chairman Larry Culp talking to David Weston. That'll be on this week's edition of Wall Street Week, which you can catch, John, Fridays at 6 p.m.
And it's been fascinating to watch GE shareholders buying into the turnaround story. Still a ways to go, Matt, to get back to where the stock was about a decade ago. And as we kick off this September trading story, Matt, we are looking at some cautious action for the S&P 500 today. Outside of that interest in energy stocks, investors certainly keeping an eye on where the economy goes from here. Currently down about 12 points in intraday trading. For Matt Miller, I'm John Ehrlichman. This is Bloomberg.
The dollar strengthens,
pushing yields higher, and that leaves the stock market stuck in the mud. Live from Studio 2 at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld, kicking you off to the closing bell here in the U.S. about 2 hours ago. You're looking at stock markets, like Romaine said, a little bit soggy. The S&P 500 off by about 0.3%. Big tech doing slightly better. You're looking at the NASDAQ 100 higher by about 0.2%. But once again, all of the action in the bond market, that sell-off resuming, especially when it comes to the long end of the Treasury curve. 10-year yields currently up about 8 basis points as we look forward to a September pretty hefty corporate issuance. And Romaine, I want to end on oil here because what a move that we're seeing in the energy market. Crude oil up about 1.3%. Brent looking at $90 a barrel after OPEC Plus extended those supply moves.
Yeah, we're going to spend a lot of time today talking about what's going on in the energy space and in treasuries. But let's start off with equities. The worst month of the year for U.S. equities. It's upon us right now, Katie. That is, if you believe the almanacs. I was going through the stock market almanacs here, and some market strategists, including the team over at HSBC, say ignore it. Some of the fears about seasonality, some of the fears about the losses associated with the 9th month of the year are mismatched with the fundamental realities. The team over at HSBC keeping a pro-risk asset allocation, saying that while, yes, September tends to be a weak month historically, the largest drawdowns historically were actually driven more by fundamentals and events. Most Wall Street strategists seem to agree. They've been in the same camp for a while now, boosting the average year-end price target for the S&P ever so higher, going back to May. Right now, it's at one of the highest levels that we've seen all year long. And of course, the market gains for the next 4 months, well, they might be dependent on the stocks that led market gains over the past 8. We're talking about you, NVIDIA, still the best performer in the S&P this year, 230% gain. If it holds those gains through December, it's going to be the first time an S&P member has tripled in value on a yearly basis going back to 2020. That's raising a lot of questions right now about whether the move is a bit bubblicious, particularly when you consider that the second biggest gainer out there isn't even in the same ballpark. And in fact, when you look at the PE ratio for NVIDIA, we're talking about a stock that historically has averaged under 40, but in the last 12 months, it's averaged more than 100. And at one point in July, it was at 200 times earnings. A conversation later today in the program with Rob Arnott over at Research Affiliates on market valuations and how, in his words, even a great company like NVIDIA can be priced beyond perfection. But the other potential driver for the market is what's been going on with the dollar, Katie. King dollar, which spent the early part of the summer looking like a pauper, well, now starting to sort of reassert itself. 8 straight weeks of gains potentially if it finishes out this week like it did last.
8 straight weeks of gains. And you're looking at another big day for the dollar. I wanted to highlight dollar yen in particular because the dollar is strengthening against pretty much all of its developed market peers today. But then you take a look at the yen. On that pair, dollar yen, we're above 147. You go back in time, that's around the levels where the Bank of Japan intervened in the FX market last year. Of course, it's a little late for them to make any moves now, so we'll see what we wake up to tomorrow. And as you can see, really, when it comes to the yen and against many of its peers, the dollar has been strengthening all of this year, really since January. And as a result, you're starting to see some of those asset managers throw in the towel. There had been a big call this year for peak dollar. And as you can see, we're still net short if we look at leverage funds, if we look at asset managers. But taking a look at the latest rounds of CFTC data, you can see that a lot of those shorts have started to be covered, especially when it comes to these asset managers. So we'll see, Romaine, how far this capitulation continues. But King dollar definitely reasserting itself.
Absolutely. And of course, having a lot of reverberations across asset-wise. Let's kick off to the close here with Jitanya Kanhari. She's Deputy CIO of the Solutions and Multi-Asset Group over at Morgan Stanley Investment Management. Great to have you here on set here on the first trading day here of the week, Jitanya, and a big focus right now on the dollar, which has been doing pretty well over the last 7 or 8 weeks.
Yeah, I think it's what really drives the cyclical moves in the dollar is the growth differentials and the rate differentials. Growth differentials, we think, is a much more powerful indicator. So the growth in the U.S. has surprised growth in China, in Europe. So I think that's why the dollar's been driven by that growth differential. Fundamentally, we still are of the view that the dollar is extremely overvalued, and a lot of the things going on with the reset in the rate differentials, etc., will start now looking more favorable for other currencies.
Well, I am curious too. When we look at the moves in the dollar and you look at the moves in yields, there's a big question as to whether the tail is wagging the dog. Sort of what's driving what here?
Yeah, I think it's clearly the real yields that's driving on the yield side.
Oh, you just said Katie's magic words.
So I think this whole reset on the 10-year yield is a phenomena. My personal view is I think we are very close to that reset happening, because what I look at is where is real rates, that is 10-year minus CPI inflation. And with such an overly indebted economy, the only way to grow out of it is with negative to neutral rates. So if we get into positive territory, that's a point where I think that, that's the end of the 10-year move.
The end of the 10-year move, how does one position for that? If you think about the ripple effects at a portfolio level, how do you prepare for that?
Yeah, so I think, pockets, if you can look at the performance of, say, the local currency index in emerging markets, that's up 8% plus this year. So I think you really have to zoom out of the cyclicality and focus on the fundamental good spots. Emerging market, real rates, local bonds have, with the rate cutting cycle are interesting. And even within, I think, the US, for example, energy as a commodity never does well when inflation goes up. It's just the way it has worked historically. With inflation coming down now, I think that is looking interesting, in terms of where we are in the economic cycle, in the market cycle for the energy sector.
For the energy sector, so you're specifically talking about the equities then, energy equities versus the commodity itself.
Yes, I'm talking about energy equities, and I think people are really, saying that fossil fuels will be gone. Energy transitions historically mean more of energy additions rather than transitions, because to facilitate the transition, you need a lot more energy. And that's what we're experiencing, more demand, supply constraints, and marginal costs that are about 80, which I think is like the bottom for energy prices. So we do like that sector from a long-term perspective.
So I want to go from energy back to emerging markets, because there's a lot of cross currents to keep an eye on. Obviously, we started with the dollar, the strength of the dollar. I'm also curious how you factor in geopolitical concerns into your analysis, because if you think about what's developing right now when it comes to India and China, of course, we have the G20 coming up, and you have President Xi planning to skip the G20. When you're evaluating opportunities in India, for example, how much of a weight is China?
Yeah, so I think what we're doing, just to kind of, put that perspective together on the geopolitical situation, we're actually looking for who wins in this geopolitical environment. And India, sticks out along with some of the other Southeast Asian countries, also some of the Latin American countries like Mexico. So it's some of these countries are globalizing in a deglobalizing world. And India, for example, not only on the manufacturing side, but also on the services side, with work from India becoming an important piece of that story. So yes, it is, a lot of it is just the beneficiaries outside of China and US in this geopolitical game, but also where there are fundamental drivers that are intrinsic to domestic demand that are less resilient on these global headwinds.
Well, on the point of India, though, I mean, they're certainly having their moment in the sun, of course, with Modi's visit here to the U.S. earlier this year, and now, of course, the big G20, which gives him an opportunity to show, I guess, what he thinks India is really about. Is that sustainable, though? Should, I guess, he not be around? We know there is an election here. How much is he driving that, and how much of this is maybe being driven by just the demographics of India overall?
I think it's a combination. One factor is never a driver of success of a nation. So I think the reform agenda put forward by Modi with the GST, with the digital stack, with the digitization of India, with the schemes for infrastructure are all adding to the overall momentum. But nothing goes up in a straight line, so we're really watchful in terms of what happens in elections, and participation on demographics continues.
For U.S. investors, or at least investors outside of India, outside of China, outside of the world of EM, we know that there is a sort of a confluence where we sort of lump them all together here. When we talk about the correlations that we're seeing, or lack thereof maybe, with China and the rest of EM, how does that stack up with the correlations that India has and the rest of EM?
So interestingly, India is more correlated to the US than China. And I'd say one thing which is really important today as we look at the heterogeneity in emerging markets. China used to be 40% of global growth in 2008 with the stimulus that they put in then. Today, China is less than 20% of global growth. Our work is suggesting that the earnings, the market correlation that China had with EMX China is actually dropping. So it's, some countries are actually more correlated to the US, and India is much more correlated to moves in the US market than the Chinese market. I'd say, in fact, it works opposite, because when interest in China wanes, interest in India goes up. So it's been an interesting trend, at least in the last year.
Yeah, certainly, and one that appears to continue to go. Always a great conversation with you. Jitanya Kanari there joining us here to kick you off to the close, Deputy CIO of Solutions and over at Morgan Stanley Investment Management. Coming up a lot more here on the program, including ARM and the IPO that, well, should be coming to fruition. The roadshow now set to kick off, and we're talking about a valuation that could be a little bit smaller than what investors at first expected, Katie.
And global trade also in focus with the G20 summit kicking off this week. We're going to discuss the impact on emerging nearshoring trends with the CEO of freight transportation broker RXO.
And an exclusive sit down with Rob Arnott, the bubble hunter, if you will, and his latest note out about the big market delusion around NVIDIA. That conversation coming up a little bit later. That and so much more. This is Bloomberg.
Thursday, Bloomberg's.
It seems more and more high-stakes decisions are ending up in my hands. While still of the challenge, I worry some decisions might not get the attention they deserve. Working with Aon means I've got their whole team in my corner, with advanced analytics and expert insights that put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
With Barclays, every change leads to a bold possibility. You have the vision, we have the insights, financial solutions, and global perspectives to help you make it real. Barclays Corporate and Investment Bank, powering possible.
Mike McKee sits down with New York Fed President John Williams at Bloomberg's Market Forum for an exclusive interview. Does he see more rate hikes? How soon for cuts? Find out Thursday at 3:30 p.m. Eastern, only on Bloomberg.
One of the biggest and most anticipated IPOs of the year is still dangling out there. It's ARM, of course, a unit of SoftBank, expected to value the company now, we're learning, between $50 and $60 billion, with ARM itself planning to raise almost $5 billion at the top of its range. Let's bring in Bloomberg News U.S. Deals Managing Editor Leanna Baker with the latest here. Let's start off here with the potential market valuation, Leanna. Roughly about $55 billion is what Bloomberg is reporting, less than the $70 billion that seemed to be chatted about, I don't know, just a few weeks ago. What gives?
There's a few things at play here. First of all, SoftBank is the big owner here of ARM, and they sold a chunk of stock, or they bought from the Vision Fund at a $64 billion valuation. So that number was out there. That was a bit lower. Now, this number is even lower, but remember, it's the beginning of the roadshow. They're going to be meeting investors this week, early next week. So the numbers can still go up. But it does seem that SoftBank is scaling back what they want to raise. Masayoshi Son, the CEO of SoftBank, doesn't want to part with as much of the company as he originally wanted to. He's very bullish on it, so they're selling just 10% to raise $5 billion. That's how you get to the $55 billion range. It's still huge for the IPO market, which has been horrible this year.
So huge for the IPO market, but it seems like chiefly this is extremely important for SoftBank if they're holding on to so much.
Right, and the company was bought out by SoftBank for $32 billion. So anything above that amount is sort of money in their pocket. Remember, they tried to sell to NVIDIA a few years ago for $40 billion. So we're still way above those amounts, and it could still continue to rise depending on investor demand. but it does seem like the headlines are a little negative today based on where they're starting the roadshow. But it's pretty common for IPOs to kind of temper expectations at the beginning and then raise it later.
Well, that's what I'm curious about, and whether that sort of euphoria ends up being raised in the secondary market. When I hear $55 billion, even a $70 billion valuation, obviously just on this stake, then of course everyone's going to look at NVIDIA's market cap, which is, last time I checked, $1.2 trillion. If these two folks are in the same game, at least relatively in the same game, then what gives there?
It's funny you mentioned NVIDIA. They're actually investing in the IPO, so maybe there's a little NVIDIA halo that will help ARM. And Apple and AMD and all these companies whose stocks are doing okay are all getting in on the IPO. They're buying up to $725 million. So there is a lot of support for this to succeed. So we'll see how it goes. If they raise up to $5 billion, though, that's still the biggest IPO of the year and is still one of the biggest tech IPOs of all time. But it's hard to say what investors are expecting out of the IPO market right now. There just hasn't been a lot of examples to look at.
Well, that's where I wanted to go because, of course, you do have all the high-profile names taking part in this IPO, and then there's the sheer size of it. And when you think about the state of the IPO market, if this goes through successfully, what could this mean in terms of some of the other companies in the pipeline?
There's going to be companies that are just a week behind them, like Instacart, Klaviyo with a K. It's a tech company. We also have Birkenstock, the sandal maker. And then there's Microsoft-backed Rubrik, which is a tech cybersecurity startup. So there's companies that are looking to go this September and October, depending on how ARM goes. But then there's the 2024 class. That's when we really will see the pent-up demand come out. That's when there could be dozens of companies that have been holding on in the private markets looking to go public. So this is going to be a huge event, not just for SoftBank, but for the whole IPO market.
Instacart, ARM, Reddit, Discord, Stripe, and Databricks. One of those companies is not like the other, but okay.
Liana, gotta leave it there. Great reporting, as always. That is Liana Baker, Bloomberg News U.S. Deals Managing Editor. Coming up on the close, a check on the state of global supply chains ahead of the G20. We're going to do that with CEO of freight transportation broker RXO. That conversation up next. This is Bloomberg.
Today is looking deeper at our ESG plans, then putting out a supply chain fire, then getting a last-minute briefing on cybersecurity. My priorities don't just shift, they shift by the hour. That's where I need Aon. Their combination of advanced analytics and expert insight keeps me up to speed and ready for my next move. Better decisions. Aon.
The Mariah is just an unbelievable place. It's a cultural oasis, and I've been given an incredible opportunity to pursue my dreams here as the head chef inside its world-renowned restaurant. Get the dessert out. I mean, people travel from all over to experience my food. It's a place for fine dining, arts, and events. And it's my home, a reflection of Saudi's culture and beauty.
Welcome back to The Close. The health of the global economy in focus with the G20 summit kicking off in New Delhi this week. International trade and supply chains at the top of everyone's minds, and RXO, well, right in the center of it. It's among the country's largest brokers of freight transportation here in the U.S. And the CEO says the firm is actually seeing a spike from the nearshoring, particularly when it comes from Mexico and trucks going into the U.S. Drew Wilkerson joining us right now, the CEO of RXO. And Drew, great to have you on the program. A lot, of course, has changed with our supply chains. But when most people think of goods coming from overseas, they think of particularly those goods coming from China and Asia. And we know there's always been a tremendous amount of cross-border traffic across the U.S.-Mexico border. But you've already started to see an increase in activity?
We are. We're seeing a huge increase in activity. Automotive has been up for us. Industrial has been up for us. Manufacturing has been strong for us. If you look at the first half of the year, we grew our volumes on cross-border freight by around 30% on a year-over-year basis. So we're seeing where customers are nearshoring, and the investment that we have made into Laredo to be a facility where carriers can come to the border and then we can put it on a U.S. carrier to go to the end destination has been a huge benefit for us.
Are the changes and the investments that those clients are making in terms of being closer to the U.S. border, do you think those are permanent changes?
I do think those are permanent, and I think we're still in the very early innings of seeing more to come.
And you mentioned, of course, the new facility that you have in Laredo, Texas. Where else are you expanding? As you try to position for this nearshoring, which, to your point, you're already seeing, do you have any more expansion plans in the works?
So as far as facilities, we're looking at across the border, on both sides of the border, to be able to continue to expand and put operations. Laredo is the central hub. When you think about where most of the freight crosses the border, it's right there in Laredo. So there are some other places that we're looking at, like Eagle Pass, Nuevo Laredo. And in the U.S., you think about what we do. We're an asset-light transportation provider. We don't own the trucks. So the location of where we're housing the people we're talking to, the customers and the carriers, isn't as important. But we have offices all over the country.
And it's an interesting time right now when you think about the balance of supply and demand. And you think about a lot of these retailers had a lot of trouble with their inventory levels. And we just got through the latest earnings. It seems like things have started to normalize. From your perspective, have we worked through a lot of those hiccups that we saw when it came to inventory?
You're absolutely right. Last year was all about destocking your inventory in the retail and e-commerce sectors. This year, the inventory levels are actually in a very good position. But as we look out towards what would be peak season of October, November, December, the biggest unknown is still what's going to happen with consumer demand. So how strong will the consumer demand be, and where will the consumer spend their dollar?
I am curious. I mean, as we speak here in New York, there's a conference taking place down in D.C. on artificial intelligence and all that it may bring us, both good and bad. There's been a big focus, obviously, on kind of the software companies and the chip makers. But I understand that there's also been an AI component that we're now starting to see creep into our supply chains and the trucking industry.
We started investing in technology over a decade ago, and we built it from the ground up, and AI was a part of that over a decade ago. If you look at our pricing algorithms that move throughout the day to give carriers and customers market pricing, that is all built off of machine learning and AI. And it's part of the reason why we have some of the best margins in the industry right now is because of the early investment that we made there.
Have you had to increase that investment as of late, or was that already, the sort of the track's already laid?
We are making the right investments. Our investment dollars are not necessarily up, but it's making sure that we're making the right investments, whether it's on pricing algorithms, whether it's on customer interfacing or carrier interfacing.
Well, I'm just curious, just to follow up on that, just in terms of acquiring either whether it's new technology, updated technology, or whatever, is there an increased cost to it now that you didn't maybe have, I don't know, 3 or 4 years ago?
No, the cost was more actually 3, 4, 5, 6 years ago because we were building the foundation of our technology during that time.
And when it comes to AI, I want to expand a little bit on what exactly you're investing in. You know, you mentioned your pricing models, for example, because, you know, when it comes to AI, there's some fantasies that we're going to get to, you know, full self-driving, those types of investments. When you look at the potential here for AI in your industry, where do you see it going?
I see 4 big potential areas. So the first is on pricing, and to where you're moving faster than what the market's doing, to where you're actually forecasting where pricing is going to go in real time. And that will allow you to have stronger margins. The second is on customer interfacing. And for a customer, it's all about using your data to help provide them solutions. So how much data can we give to tell them what day of the week they should ship something, what mode of transportation they should use, all of that stuff. The third one would be on the carrier side. And for the carrier side, it's all about giving them something that's easy to access, something that they're able to come back to, and it gives them real pricing to where they can't get that anywhere else in the industry. The last is, I think where you were hitting on, is employee productivity. And so we don't necessarily see the employee count going down, but what we do see is productivity goes up. The loads per day that our reps are handling will continue to go up because of our investment in technology and our investment in AI.
Is there going to be additional consolidation in this industry? We were talking, I think it was a few weeks ago, the idea that you have Yellow effectively going out of business, or at least seeking bankruptcy protection. And we know there's been a lot of consolidation of the independent truckers.
Absolutely. When you look at the brokerage industry, there's still a lot of opportunity for consolidation. There's around 20,000 brokers across the country. Now, when you look at it, the majority of the volume is made up by the top 10 to 15. So I think there's a lot of opportunity for consolidation, and the winners are going going to be the ones who have strong customer relationships, the ones who have invested in technology and have great people.
I have to ask you about your voice here. Was this a work-related injury or something?
This was not a work-related injury. I learned that when you go to a South Carolina Gamecocks football game, don't let your emotions get the best of you. And from now on, I'm going to let my 11 and 13-year-old daughter do all the yelling.
Well, that was a brutal game, 31-17 against North Carolina.
It was rough.
All right, Drew Wilkerson there, the pride of South Carolina, and the CEO over at RXO. This is Bloomberg.
The more my company grows, the harder it is to stay focused on our core product. I need to master DE&I, ESG, M&A, even how to adapt to hybrid working. The more hats I wear, the more I need Aon. They bring their whole team to the table and give me access to great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
This is the countdown to the close. Let's get a check here on what's going on in the commodity space as we wait for settlement right now of NYMEX crude futures. The big story in the commodity space has been all about Brent crude. Second line of your screen there, back above $90 a barrel. Back now to not only a fresh year-to-date high, but the highest levels that we've seen going back to November. OPEC Plus, the Saudi Arabia saying that it's going to maintain those cuts for at least another 3 months here, and some of the other dynamics in the space helping to elevate prices. As we wait for settlement of NYMEX crude at 86.66 and change here, you are still looking at the highest levels going back to November 2022 as well. We should point out while gasoline futures are slightly lower on the day, earlier in the session they did hit the highest seasonal levels that we've seen in quite some time, and the AAA numbers at the pump also soaring, showing that is now being put directly onto the consumer. Flip up the board here because there is a lot of discussion right now about just how high energy prices can go. The bets right now on $100 a barrel on WTI, $100 a barrel on Brent. Those bets are now starting to accelerate. The blue line in your screen, that's WTI, with a lot of folks seeing a much sharper acceleration for the New York traded futures than what we see over in London. Outside of the energy space, there are some other commodities moving as well. Keep an eye on gold as we flip up the board once again here with the big moves in yields, the big moves in the dollar. Of course, that has had an outsized impact on gold futures. 1952 right now, down about 0.8%. Meanwhile, still some optimism over there in China. Iron ore futures did rally as much as 2% a little bit earlier on the session. This after learning that some of the property developers over there may actually be finding some degree of a light at the end of the tunnel over their saga. And Katie, I know you've been following sugar and sugar futures for quite some time. I thought it was interesting. The largest sugar trader out there basically saying they expect a 6th straight year of deficits in that space, which, of course, would then underpin prices here. I know that doesn't quite dovetail with what you talk about on real yield and your other properties that you have here, but a big move here, at least on the day, up about 3%.
Supply demand, it extends to the bond market as well. And of course, it extends to the energy space. And as Romain mentioned, in a more aggressive move than traders expected, Saudi Arabia and Russia announcing that they're extending their oil supply curbs by another 3 months. Bloomberg's Julia Fanzares has the story. Julia, talk about the expectation versus what we actually got and how much of a surprise that actually was.
I think traders are really surprised, not by necessarily the quantity, but the fact that it has been extended until December. So they expected that Saudi Arabia was going to extend their production cuts 1 million barrels a day. But till December, that's really going to tighten the market to the end of 2023. And that's what really caught traders by surprise and what sent markets soaring to above $91 a barrel for Brent at one point.
I am curious, is this all just a supply story, or is the demand also helping to underpin prices?
So far, absolutely, demand's always going to be part of the component, but so far the demand story hasn't been as strong. And so really, people have been looking at supply, especially because now that there were more Iranian barrels coming into the market, this is almost as if Saudi Arabia is responding directly and saying, well, if that's going to happen, we're going to continue to pull back.
On that point, because I'm just curious, because when we talk about what sort of elevates us to 100, if that's where we go, and more or less what keeps us there, this is where we were a few months ago, earlier this year, or last year, and it was all because everyone thought there was going to be this big reopening in China, and that was going to fuel it. Now it seems like this is all just about whatever the Saudis, Russians, and Iranians are doing.
100%.
Yeah.
Last year it was the demand story. You've got the COVID reopening in China. This year it's all about supply.
Yeah.
It is interesting also that we are talking about demand and that sort of letdown that we've gotten from China. And then you think about the past summer that we've had in the oil market. For a while, it felt like a bit of a quiet rally, and now it feels like maybe we're starting to break out. When you're talking to your sources, analysts, and investors, are they rewriting their forecasts right now? How high is the ceiling?
I definitely have had some people say that they are rewriting their forecast, but I think what's really interesting is that people weren't trading as much this summer. So I think a lot of people, it was a little bit more bearish than people anticipated, and then the market should have been a little bit higher at the moment because there wasn't that much supply. And so now that we're ending the summer session and more people are coming into the market, maybe now it's a time that people are once again amping their bets for oil.
All right, Julia, really appreciate you.
How much am I going to pay at the pump? That's all I really want to know, Julia.
Hopefully not $4 a barrel this fall.
Okay.
Well, stay
I'm
tuned.
going to switch to one. You're pretty eco-conscious because you just ride a horse into work.
That's true. I do drive the car to get to the horse, and pay an arm and a leg to do that.
So you're balancing out your carbon.
I don't want to be too eco-friendly. In any case, Julia, really appreciate your reporting as always. That is oil reporter Julia Fanzares. Now, still ahead, Charter goes head-to-head with Disney. We're going to look at why the telecom and media conglomerates are in dispute after failing to reach a new distribution agreement. We analyze the risks and also the precedent that this could set for their sectors. This is Bloomberg.
All right, let's get right to our top calls. The big movers on the back of analyst recommendations, and we start with Synchrony. RBC cutting its rating to sector perform. The firm now saying that it favors, quote, top-of-the-wallet credit card companies like Amex and Discover. RBC says that it sees near-term risks from regulatory changes that may actually clamp down on some of the excessive late fees and a shift in consumer spending trends that may work against Synchrony. Those shares down 2% on the day. Next up, Lowe's raised outperform from market perform at Bernstein, with the firm citing margin expansion and improving return on invested capital as the market for home improvements remains supportive of the stock in the near term. Nevertheless, Lowe's shares down fractionally on the day. And finally, let's take a look at Vail Resorts. With the ski season approaching, Stifel sees a favorable setup for the company given its passionate high-income consumer base and what the analyst calls a pristine balance sheet. For that, the firm raising the stock to buy from hold the shares, reacting in kind, up 5% on the day. And those are some of our top calls. We want to stay in the sell side space right now and take a look at, well, an interesting dispute that's going on right now between Disney and Charter Communications, going toe-to-toe over pricing negotiations. Charter, the cable company, and if you have Charter, you probably already noticed this, ESPN, Disney, gone right now from the network. Charter says it shouldn't have to pay so much for Disney's content, and Disney says, well, fine, we're going to pull our channels until this gets sorted out. Jonathan Chaplin joining us right now, founding partner at New Street Research, to talk about his perspective here on, I guess, well, who ends up winning between these two behemoths here? He has a buy rating on Charter. And Jonathan, I know that the executives got on a conference call on Friday to try to ease some of the concerns among investors here about just how much of an impact that this impasse could have on their results. What did you learn?
So what we learned is that this is not a run-of-the-mill carriage dispute. Charter, I think, is very serious about walking away from Disney if they can't get better terms. That would be, I think, sort of an historic event for the industry. It could have really big repercussions for the balance of power between content and distribution going forward. Charter's basically reached a point, Romain, where the cost of pushing through another increase on their customers is roughly equal to the cost of dropping Disney content and losing subscribers. And so it's just not worth it for them to push through the increase that Disney's demanding.
I was going through one of your recent notes, Jonathan, and I thought that was interesting. I hadn't really thought about the trade-off here. In the old days, it just seems like the cable companies just kind of accepted the fact that this is what it costs, and if you want to keep consumers, particularly those that are really passionate about things like sports or whatever other content Disney has out there, then you just pay it. But you're saying we've now reached some sort of inflection point. Are we going to see this play out with some of the other cable companies as well?
Romain, I think we are. So content has been king for 20 years. The content companies have had a monopoly on an asset that the distributors have needed to keep subscribers on their platform. And over the course of the last half a decade, most of that content is available in lots of other places. And so the benefit to a distributor of being the one to be able to provide that content has really gone down. The one exception here is ESPN. But what Charter said is of all Disney content, only 25% of their customers watch it. And only a half of that 25% are what they call sort of passionate consumers of the content. So those are probably the ESPN consumers. And what Disney's demanding is a price increase for the vast majority of Charter space for the benefit of content that's going to 12.5% of Charter space. And that's why they're on the line and they're not willing to take it this time. I think it has big consequences for all future content negotiations that Charter has, but also for the rest of the industry. This was the tough one. The most difficult content company to stand up to is Disney. The only company that could really do it is Charter, and they've done it. And from here, I just think it gets easier for all future content negotiations for everybody.
So, Jonathan, wrapping that all together, looking at your research, you posed the question before the call, is this the tipping point? Now that we're past the call and you've had a few days to digest, I'll ask you that question. Is this the tipping point?
So we don't know yet. What Charter was willing to offer Disney was more generous than what I think they should have offered Disney. It seems like the executives were in discussions over the weekend. They're still working hard at finding a resolution that keeps Disney on Charter systems at a cost that's palatable to Charter. And so this might not be the critical tipping point, but this is the first big standoff like this where it seems like there's a decent chance that we just end up not being able to get Disney content on Charter's platform going forward. And if that happens, I think we'll look back at this as a tipping point.
And Jonathan, let's game this out. How do you see this ending? Does a side have to blink here, or could we actually see it end up just like this, where neither side blinks?
So there's a decent chance that neither side blinks. I think Disney has an assessment of the damage that pulling content from Charter's platforms will do to Charter, and they think that Charter needs to blink. Charter's done the analysis and decided that they're indifferent. Rather than take Disney's offer, they're happy to take the hit from lost subscribers. And so they're saying they're not going to blink. And so this is a classic impasse. In the past, these impasses have always been resolved through negotiation, but this might be the one that isn't. And if it turns out to be the one that isn't, we'll look back at this moment at a critical shift in the power dynamics within the industry.
Yeah, I certainly think that's key. I mean, we've seen these disputes before, particularly when you have football season here in the U.S. kicking off, a great time to sort of try to rattle consumers into being on your side. But this time may be different. 15 million TV subscribers on Charter now without ABC, ESPN, or some of the Disney-owned channels. This could be an inflection point, according to Jonathan. Jonathan Chaplin there, founding partner over at New Street Research. Coming up here, a bigger conversation about AI. And, well, it's a fast game, but time might be already running out. We're actually going to talk to the co-founder of a company called Inflection AI. He has a new book out called The Coming Wave. It's part of our Wall Street Week Daily segment. You definitely want to hear what he has to say. That conversation coming up after the break. This is Bloomberg.
Roller coaster prices, supply chain glitches, political unease. They do their best to wreck my business plans. With so many unknowns, how do I know I'm making the right decisions? Aon helps me stay on top of things. They have expert points of view on volatility from around the world, paired with local insight that helps me get back on solid ground. Better decisions. Aon.
There's a place where global markets are always open, where you can explore and discover innovative new offerings and hundreds of trading products right at your fingertips. That's SIBO, the exchange for the world stage.
Welcome back to The Close. It's time now for our Wall Street Week Daily segment. The host of Wall Street Week, David Weston, joins us as he does every day at this time. I haven't seen you in a while, David.
No, exactly. Good to see you. Hope you had a good holiday. We talk about generative AI all the time. You and I talk about it.
We do, yeah.
And there seems to be a couple of camps that it's going to be the end of the world as we know it, or maybe not so bad. But we fortunately have a real expert in generative AI. He's Mustafa Suleyman. He's the author of the new book, The Coming Wave, Technology, Power, and the 21st Century's Greatest Dilemma. He's also CEO of Inflection AI and was a co-founder of DeepMind. Mustafa, thanks so much, and congratulations on the book.
Thank you very much. Great to be with you both.
So you describe in the book waves of technology, going back in history, that we have these waves of technology. We are going through one right now. And one of my questions, having read the book and hearing some of the consequences of this, is this a difference of degree or of kind when it comes to generative AI? Is it just a bigger one, or is it something different?
Yeah, when you look back at the history of technology, it's pretty clear that there are some consistent characteristics. If something is useful, everybody wants to get access to it. And so it tends to get cheaper and easier to use over time. All of the major general purpose technologies have that characteristic. And what that means is that they spread far and wide. That drives productivity, makes us all smarter and more capable, and it's actually a huge win for humanity. But on the flip side, these two new waves, that is synthetic biology and artificial intelligence, have slightly different characteristics because they actually have the power in some sense to self-improve. They can get better over time. And so that's where I think people who have concerns, you alluded to at the beginning, start to get a little bit worried about what they might turn out in the future.
So, Mustafa, I'm glad you raised synthetic biology, because one of the points you make in the book is it's not just AI, it's AI and synthetic biology, and in fact, they may be interacting with each other, it may take us in a whole different direction.
Yeah, one drives another. So computational biology has now turbocharged the field of synthetic biology. We can now not just read the code of life with DNA, but we can synthesize or print new strands of DNA, new compounds that make us, for example, make our foods more drought resistant or make them require less water, more efficient. And that's a huge transformation. We're only going to really start to see the benefit of that in the next decade.
I'm glad you used the analogy of DNA. The last few times that we've sat on sort of the precipice of these huge technological innovations, there was a huge government role in sort of facilitating how those innovations got developed and, more importantly, how they got distributed, including with the Human Genome Project, even with the internet itself here. We still don't necessarily have that yet with AI.
That's a great point. I mean, the cutting edge of AI today is actually driven forward by the big tech companies, big private companies. You need vast amounts of computational infrastructure. It's really expensive. You need the top talent in the world. You need access to vast amounts of data. So unlike when we sequenced DNA back in 2000, the great Human Genome Project, this wave is actually driven forward by big private companies.
Well, one reason why I bring that up is in your new book, you make the point that all technology to a certain extent is political, or at least there's a certain political power that comes with controlling that technology. And yet here is a technology that, at least right now, seems slightly outside the grasp of major governments.
I mean, technology by definition is an enabler, right? It's an amplifier. It helps us to be more productive and get things done, but at the same time, it also enables bad actors to get things done too. And, you know, that's no different in this wave. It's going to be the greatest force amplifier, if you like, in history. And so this is the moment when we have to think about how do we make sure these technologies are accountable to our democratic governments, and how the nation state is strong enough to be able to adapt quickly enough given the rate of change that we see on the technological front.
One of the things that's going to be amplified according to your book, not the main thing perhaps, but one of the things is going to be the economy. You talk about $100 trillion potentially a difference here. Explain how that works. Suppose this works the way you expect it to. Where does $100 trillion come from?
Well, think about it like this. Everything that has ever been created in the world today, everything in your line of sight, has been touched by us humans. And what makes us unique as humans is our intelligence, our ability to look back and analyze information, collect it together, make some prediction about what might happen next, and use that creatively to invent things and make new things to advance our world. We're now taking that skill, intelligence, and we're turning it into a piece of software that can be reproduced over and over again and made into a commodity. It's going to be widely available to hundreds of millions of people. That's going to make us much, much more efficient and productive and much more creative. I think that's going to produce unprecedented value in the next decade.
That sounds great. I'll sign up right now. At the same time, in your book, you talk about the great dilemma that we may well be facing, a dilemma between catastrophe on the one hand and dystopia on the other. So how do you get from that wonderful way you described to dystopia or catastrophe?
Look, the downside of being able to distill power into an algorithmic construct and make it cheaper and cheaper is that many, many millions of people who might want to destabilize our world could also potentially get access. And that's the thing that we've got to wrestle with. If we're completely open about this new wave, then there is the potential for there to be catastrophic side effects. People who use it for spreading misinformation, engineering new biological compounds which could be dangerous to us, amplifying the polarization that we already see in our world today. At the same time, if we really lock up and try to restrict and contain it, then there's always the risk of dystopian authoritarianism. And that's the narrow path that we have to tread between these two downsides.
Are you confident, though, that we'll thread that path in a, constructive way?
Look, I think the incredible thing about the last 12 months is that the world has seen how powerful these tools can be, and governments all around the world are reacting. I mean, faster than ever before, actually, with respect to previous technologies. Just recently at the White House, President Biden announced the voluntary commitments that my company, Inflection AI, and 6 other leading AI companies have all signed up to. And whilst they're not binding, it's still a first step in the right direction.
But given the nature of this technology and given the nature of the variety of countries out there that want to utilize this in some way or another, does it help at all if, say, one country, say the U.S., passes rules, if those rules aren't also done in tandem with the EU, with Asia, et cetera?
We will ultimately need global cooperation. But at this moment, we have to be optimistic and encouraging of the nation state. This is a moment when the state has to adapt and evolve, just as we all have to evolve to these new technologies. There's no way to put the genie back in the bottle. This really is happening. So the art is going to be around shaping it in the public interest and making sure that our democratic governments remain in control.
Can the United States give an incentive, if not force, some of those reforms? You've been quoted actually in the Financial Times as saying we really should be forcing it by having a bottleneck when it comes to things like some of those microchips.
Yeah, that's exactly right. I mean, we should look at our supply chain to identify choke points. And at the moment, thankfully, the United States and, Europe are the leaders in technology development across the board. That means that we control the chips. There's only a few number of companies that actually produce these chips. All of the algorithms and the software run on these chips. And that presents an opportunity to use that chokehold to impose restrictions and safeguards and ultimately regulations in terms of the way that it's released to the world.
Okay, thank you so much, Mustafa, for being here. It was really great. That's Mustafa Suleyman. He is the author of The Coming Wave, Technology Power and the 21st Century's Greatest Dilemma. Tomorrow we're going to talk with our own Stephanie Flanders about China's economic struggles. And then on Friday, we'll hear from GE CEO Larry Culp in an extended interview about his 5 years at the helm and what comes next for GE. That'll be at 6 p.m. Eastern Time on Friday, Romain.
It's been an interesting 5 years for him
a lot of changes.
GE, and of course GE, old conglomerate now, I guess a disparate company, if you will. David Weston, you can check him out every Friday on Wall Street Week, and of course here every day on The Close around this time for our daily segment. As we round out into the final hour of trading here on this Tuesday afternoon, a middling day for U.S. equity markets with the big focus right now on the moves that we've been seeing in the FX space with continued strength in the U.S. dollar, and of course what we've been seeing in yields. 496 and change right now on a 2-year yield here, having massive reverberations for the rest of the cross-asset space. Stick with us. Romain Bostic alongside Katie Greifeld. We'll be back after the break as we count you down to the close. This is Bloomberg.
My priorities don't just shift, they shift by the hour. That's why I need Aon. Their combination of advanced analytics and expertise helps keep me up to speed and ready for my next move. Better decisions. Aon.
Opportunity. People.
Things get done
Before, I never did business in Georgia. I was amazed what kind of opportunities. There are many of them here.
Very little bureaucracy, simplicity of doing business.
You have access to markets, finance, and authorities.
It's perfectly located logistically. We have the biggest suppliers nearby.
EBRD has invested 4.6 billion euros in 270 projects, and I think that speaks for itself.
Georgia.
A pleasure
doing business.
This is the countdown to the close. I'm Romaine Bostic.
And I'm Katie Greifeld.
A view from the top here of financial markets on this Tuesday afternoon. The fastest hour on television begins as we round out here into the final hour of trading. In S&P 500, Katie Greifeld really hasn't gotten much traction at all today, down about 0.1%.
Yeah, not too much action there. And of course, volume, it is higher than what we've seen, but coming off a pretty low base.
Yeah, a pretty low base. And I mean, you take a look at sort of kind of what's moving us here. A dollar strengthening, yields moving higher, oil prices hitting, I guess, fresh year-to-date levels here. And it's a big part of the reason why you're seeing the S&P. And really, for the rest of the market, quite frankly, just kind of stuck in the mud like those influencers out at Burning Man here. Take a look at the Russell 2000, Katie Greifeld. I know you were out at Burning Man here, but the Russell 2000 down 2% here on the day, I think is probably more indicative of maybe market sentiment right now than what you're seeing in the S&P 500.
Certainly more so than what you're seeing in the VIX, for example. Volatility continues to drain out of this market. But yes, small caps really taking a beating as we see that bond sell-off resume really across the curve. The last week or so of August got a little bit funky when it comes to the narratives, but really reinserting themselves on the second trading day of August.
Flip up the board real quick. I do want to take a quick look at the dollar, up about 0.7%, at least as measured by the Bloomberg Dollar Spot Index, coming off what had been 7 straight weeks of gains. This would be an 8th straight week of gains, Katie Greifeld, which last time I checked would be the longest win streak since the inception of the Bloomberg Dollar Spot Index back in 2005.
And it's interesting to reflect on this as well as what you're seeing in oil, because it feels like it's been a quiet rally for both asset classes. And suddenly you look back on the size and scopes and we're at the highest levels in months. And you, again, can really see that consistent gains in the Bloomberg Dollar Index. Same goes for oil.
Yeah, absolutely. Here, we talk about some of the individual movers. We should just point out real quickly, Katie Greifeld, United Airlines, which at one point was down 4%, not only down about 2.5% on the back of that ground stoppage, which then was almost immediately canceled. We'll have to find out exactly what's going on there.
Yeah, we'll definitely be covering that a little bit while later. But let's talk about Oracle, because it's having a great day on a pretty soggy day for the market. Oracle up about 2.5%. That's after an upgrade from Barclays. They see a multi-year growth story for this company, upgrading to overweight from equal weight. They're also matching the street high. They see strong growth at high margins. That's all good news.
Interesting. 2.5%, a bright spot on the day. One of the big decliners that I saw you had up there was Manchester United, down 17%.
I had to do a lot of research for this one. So it's interesting. This is, I believe, a record.
Or football, as the kids in Europe call it.
Football, soccer, whatever you want to call it. All I know is that the Daily Mail had a report out in the Mail on Sunday saying that
Daily Mail?
The Daily Mail, the Glazer family, they're reportedly, again, according to sources, going to take the club off the market. They had been hoping to get multiple serious bidders here, and they only ended up with 2.
If you can't believe the Daily Mail, who can you believe?
I know. It's important to have some truths in this
You had another stock up there. What's going on with that?
Holte Group, home builders, just having a terrible day.
What did the Daily Mail have to say about that?
Not much, but you told me it was all because of higher yields.
I think it is because of higher yields. In fact, most of the home builder space moving lower as we are less than 1 hour away from those closing bells. Our cross-platform coverage, counting it down to the close. That coverage starts now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostic here alongside Katie Greifeld. We're joined right now by our colleagues, Tim Stenovic and Jess Minton. Jess filling in today for Carol Masser. Welcome to our audiences across all of our Bloomberg properties here on a Tuesday afternoon where we're looking at a market pretty much across the board in the red, though we should point out the NASDAQ indices now poking into the green on what coming off a holiday weekend, Tim, where I think everybody's supposed to be back in the office.
I was going to say everybody's supposed to be back. She's on vacation. You know, she didn't take much vacation this summer, so she always likes to take a little bit.
She only
in
works
August.
3 days a week.
Wait, did I say August? In September? When?
It is September.
Is it September already?
Yeah.
Okay, well, here in the U.S., it is post-Labor Day, and of course, it's kind of this reset. The kids are back in school. Unless you live in New York and the kids are not back in school yet. But nowadays, Labor Day has kind of turned into this moment where each year companies are saying, okay, well, we're doing this reset. You need to be into the office X number of days per week, starting Labor Day. Indeed, we're seeing that with Amazon. We're seeing that with Zoom. It's not just a U.S. phenomenon, though. This is happening around the world. And today's Big Take takes a good look at, Jess, the economic impact of what could happen if things don't recover to pre-pandemic levels with people actually going back to work.
And clearly the stakes are pretty big here when you see the dollar figure at $1.3 trillion of real estate value in big cities potentially being erased by 2030. So eye-popping number there, but also just looking at what happens when the dynamic, when you're looking at what's happening with workers in Asia and Europe coming back to work in office more quickly than some of its counterparts, obviously over here in the U.S., Tim.
Yeah, I thought it was interesting, too, looking at some of the country data. I mean, what country has the most work from home? Do you know?
The most working from home?
Yeah, in terms of hours work from home.
Isn't that us?
No, I thought
Is it Australia?
It's
Australia?
Canada, believe it or not.
Canada. Okay.
And then number 2, I think, was the UK. And then
Wow.
I think the US finally comes in number 3.
That's really interesting because, I mean, maybe
Once
this
again,
is...
we're losing out to the British Empire.
We're just losing
It's been
here.
happening for quite a while.
Yeah.
I was going to say maybe it's the echo chamber and the fact that I live in the U.S., but I feel like we talk about it much more over here.
Maybe if they kept track of the minutes we talk about it, then we'd be in the lead.
You know, it's the fewest, at least among the big developed nations.
Taiwan?
South Korea.
Oh.
Yeah.
Wow.
I keep just getting it wrong, Romain.
Yeah.
God,
Well, it's only Tuesday.
There's plenty of days to continue to get it wrong later this week.
Let's see if we have any quizzes coming up in this next story, because the story that we've been following about with the IPO market, of course, is that ARM roadshow. There's another great story out by our deals team saying that SoftBank's ARM Holdings is planning to raise as much as $5.87 billion. That is significantly smaller, Romain, than some of those previous targets, if you will.
Yeah, I'm curious, too. I mean, there's been a lot of talk as to why the valuation is coming in lower. Some will say that, well, you're talking about a company that doesn't quite have the same AI pedigree that you would get out of, say, an NVIDIA. But at the same time, there's a lot of talk about what the ownership structure of this company is going to look like, with SoftBank actually retaining a much larger stake than I think what people had thought.
And also still even at the lower end of this range, it still would be the world's biggest IPO at this point, even surpassing what we saw last month when it comes to Kenvue, too. So even though we did see some moves there, still pretty big there.
And just to the point about its size, I mean, again, there's two interesting stories here, like Romain touched on. You have the ownership structure and then just the sheer size of this. So it's really important for SoftBank, and it's really important for the sentiment of this IPO market.
You know who it's really important for?
Tell me.
The investment bankers, Katie. There are fees at stake here.
I know.
Don't forget them and the lawyers.
There's a lot of heavy hitters attached here.
They're the drivers of this economy.
Romain, I thought you were going to say it's really big for Birkenstock.
Yeah.
Birkenstock.
Because that's
go
one of the
public too?
companies. That's one of the companies on the sidelines right now, and
Yeah,
you know,
shoes.
It could be going
Sandals.
public very
Yeah.
soon.
I saw Reddit was actually going to go public as well and Discord.
I'm so
What's
interested
happening?
to see how that goes.
Well, that's why we're watching.
Is that a $55 billion valuation as well?
You never know.
That's why we're watching this one so closely.
Yeah.
If it does well, if the roadshow goes well, then maybe we could be talking about a lot of IPOs.
In all seriousness, though, this does
get.
get to the broader issue about market sentiment, though, Tim.
Yeah.
Yeah.
Okay.
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 Yeah.
Hey, you
Yeah,
guys,
no
we're going to
comment.
be back with you in just a bit, so don't go too far. That is going to
We'll
do it
try.
now. We're back on live TV, radio, and YouTube, and of course on Bloomberg Originals at 4 p.m. for our Beyond the Bell coverage. We're going to take you through today's market close.
We continue our markets coverage right here on The Close, and a focus right now on emerging market bond investors and some of the risks they're facing, a trifecta of risk, at least if you believe what BNY Mellon's Bob Savage had to say. He told Bloomberg that higher for longer U.S. rates, carry trade volatility, and elevated debt levels will continue to place headwinds on the EM space. Let's get some perspective out of Kristen Seva, Managing Director and Senior Portfolio Manager over at Payton and Regal, where she directs $11 billion in emerging debt strategies. How are those strategies, I guess, playing right now, Kristen, given what we've seen in the moves in rates and, for that matter, in the FX space?
Well, I think if you look at things on a longer term basis, we really like local markets today for the longer term, medium term type of trade. And with regard to rates, EM central banks hiked earlier than the Fed. They're starting to cut rates right now. Disinflation across the EM space, not just China, but across EM. And then I think on the FX side, we like the EM FX space as well, just given the very high valuation of the dollar and the twin deficits that we see in the U.S. structurally.
Well, break this apart for us. I mean, we know EM is kind of this, wide-ranging thing and not necessarily the monolith that sometimes we talk about it as here. What pockets of EM, at least EM debt, we should say, is more attractive to you?
As I mentioned, I think some of the local markets trades. So, looking at bonds that are denominated in that particular country's currency markets, we like from both the rates and the FX perspective. And then I think that on the high yield side, we like a number of different BB types of sovereign credit names that we think have value here over the IG space. So I think there's a lot of attractive opportunities in corporates as well that we're looking at, very well-managed corporates in countries that we like.
That's what I wanted to ask. When you think about the balance of corporates versus some of these sovereigns, the fact that you are seeing maybe more opportunities in corporates right now, what is the typical dynamic? Is that unusual?
Well, I think for us, we like certain corporates that we think can add value because corporates trade at a spread to sovereign. And so I think for a well-managed corporate where we see value, we like to be involved in those types of names. And remember that across the board, EM leverage is actually lower than U.S. and other developed market corporate leverage for each rating category. So you're getting that spread per turn of leverage that's very attractive in corporates as compared to developed markets.
And Kristen, it's hard to have a conversation about emerging markets without talking about China and this drip feed of stimulus that we've gotten. When you look at the economic numbers coming out of China right now and this sort of piecemeal stimulus that they're unleashing here, how has that trickled through the emerging market debt space?
Well, remember, in the emerging market debt space, China is a much smaller component of these markets than in the equity space. So on the indices that we follow, typically less than 5% versus 30% in the EM equity space. So China itself is not as important in EM debt spaces. But I will say, of course, it's important to the overall macroeconomic picture. And I think that China and its impact on the rest of EM is very different now than it was 10 years ago, because China is shifting from a very manufacturing-led economy to a services-led economy. So the countries that are impacted are going to be less the commodity exporters and more so those exporters, including in Western Europe, to the consumers in China.
When we look at, I guess, the interaction with China by some of the other nations, obviously primarily the U.S., but also some of the other major developed nations, the idea of diversifying their supply chains, diversifying their relationship here, are there other beneficiaries in the EM space from that?
Sure, I think Mexico is one, because you're seeing a lot about in Mexico about nearshoring and a lot of manufacturing space that's being created in Mexico in terms of warehousing and so forth, to be able to take advantage of that. That's why I think we've seen the Mex peso very strong this year, benefiting from that kind of nearshoring trend. So we're seeing that in places in Latin America, particularly Mexico, and then also in countries like Indonesia that are benefiting from steel manufacturing and taking over some of those types of things that used to be dominated by China.
All right, Kristen, really great to catch up with you. That is Kristen Seva. She is Managing Director and Senior Portfolio Manager over at Payden & Rygel. Now, coming up, we're going to speak with Hamilton Rayner. He is the man behind the wildly popular JP Morgan Equity Premium Income ETF, or JEPI, which has taken in more than $11 billion this year.
That's going to be a great conversation. We're also going to have a great conversation with Rob Arnott, an expert on value investing, and why he says there's a lot of delusion right now around NVIDIA.
And Apple TV gets a lift from Messi Mania. More on the bump in subscriptions. All that and more coming up. This is Bloomberg.
It seems more and more high-stakes decisions are ending up in my hands. Aon's advanced analytics and expert insights put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
unprecedented demand for actively managed ETFs being led by one product in particular, the JP Morgan Equity Premium Income ETF, known as JEPI. JEPI, which invests in low volatility stocks paired with a call writing strategy, has already taken in more than $11 billion this year. That's after beating Cathie Wood's record for active ETF inflows last year. And joining us now, I'm thrilled to say we have JEPI's portfolio manager, also the head of U.S. equity derivatives over at JP Morgan Asset Management, Hamilton Rayner. Hamilton, it's great to have you on set with us. And the interesting thing about JEPI in particular is that this enormous bid, these billions of dollars, they're still coming in. Even if you look at the performance of JEPI this year, at this point, it's actually underperforming the S&P 500 on a total return basis. Where is this bid coming from? What does that say about sentiment in this market?
Sure. So first of all, thank you for having me. When I think about JEPI, I think the reason JEPI has really resonated with investors is a couple things. As you mentioned, the long portfolio is challenged by the market right now, and I would say that's because it's a little bit more of a higher quality portfolio. We're going to be structurally underweight technology. We're going to be structurally underweight the higher volatility names, which are wonderful. But last year was also a nice tailwind for the strategy, helping us lose less. When the market was down 18 or so, we were down 3.5. But the reason I think the strategy continues to resonate today is because we're up 18, 19% year to date. Pretty remarkable. If we would have started the year and said we're going to up 18, 19%, in the day after Labor Day, we would have said, done, take it. But now what? So I think there's three things that could happen with the market. We can continue to go higher, and the other 493 names that have not participated will start participating. We could be range bound. Or maybe the market takes a deep breath and settles in and maybe sells off a little bit. All three of those environments are pretty good for JEPI. In a range bound market, you're still going to get the dividends and the options premium. If the other 493 names begin to work, then we should see our long portfolio act quite well. And if the market sells off, these higher quality names, which have not participated in the rally year to date, should probably hang in a little bit better as well. So we are seeing people continue to use this as part of an overall portfolio allocation.
And I do want to talk about a little bit how this is translating through this big bid that you're seeing into JEPI into what we're seeing in the volatility market. Because Romain and I talk about every day, you look at the VIX and it looks broken. And there's some on Wall Street who have theorized that the fact that you have some of these products, such as JEPI, that are basically selling calls, they have these writing strategies, that's suppressing volatility when it comes to the VIX. Help me square that circle. Does that hold water with you?
The market for S&P 500 index options is enormous. $1.3 trillion per day trades. So a strategy like JEPI, which is just under $30 billion, and we ladder and stagger our options doing a tiny fraction each and every day, each and every week, is not going to actually have the type of magnitude that people are suggesting that we do. With $1.3 trillion of S&P 500 index notional per day, and that's the largest it's the largest equity in the world, the largest option for sure in the world. We're not going to be able to have that type of impact. The market's just too big.
Well, I'm curious, though, about just the general strategy, the active management strategy, part of this here, and what value proposition that offers versus, I guess, if you were just to take some of the holdings that were in JEPI, just for example here, and you overlaid that with some of the other ETFs that have, the passive ETFs that have similar names in them, what is the advantage you have doing something like a JEPI versus doing one of those?
I am so blessed to work with 21 career analysts that do fundamental bottoms-up stock analysis. And that adds value, right? We're not just buying names because they are the lowest volatility names or the lowest beta names. These are stocks that, first and foremost, we find fundamentally attractive over the medium to long term. Then on top of that, we're looking for those stocks that have less volatility and less earnings variability. Because if you just do call overwriting on an index, you end up being capped to the upside, eating all the downside. Having a wrong way up-down capture. But the long portfolio that's fundamentally driven, we think adds value.
And of course, I mean, clients, of course, like to sort of see the new shiny thing and they want to make sure they participate. There's been a lot of this hype about AI, all this concern that a lot of the gains we've seen in those AI stocks are just basically just multiple expansion. Is there something that fits more into that sort of income fund type of stream that still sort of plays to the growth prospects in AI?
So my other child, JEPQ, or JP Morgan Nasdaq Equity Premium Income, which we've seen some success with as well, actually at the centerpiece of that uses AI from an investment perspective. Imagine when you think about stock selection, what drives good stocks? Long-term fundamentals drive good stock performance. And how do you get, how do you analyze fundamentals? You try to consume as much information as possible.
Yeah.
So what if you had an investment process that every night was able to consume 45,000 different periodicals, newspapers, what have you, in 90 countries, in 40 different languages, to consume that information, to forecast financial information? It's pretty darn robust. And so with JEPQ, at the centerpiece of the long portfolio, we're using AI at scale. We're consuming more information than humanly possible to actually to analyze these stocks. But it's not about factors or signals. It's really looking at the fundamentals of stocks. If you asked me to do fundamental analysis on a stock, what would I do? I'd read as much as I could. But how much could I really read?
Yeah.
These processes enable us to actually, do things at scale. It's pretty exciting.
JEPQ, it's second on the leaderboard for active ETF inflows year to date, behind JEPI. I love talking to people like Hamilton because you manage both mutual funds and ETFs, and I hang around with Eric Balchunas all the time, so I view the world from a very ETF-centric point of view. But what strategies at this point still work better in a mutual fund that you still would prefer that wrapper for over an ETF?
Sure. So I manage strategies. We just want to deliver in whichever wrapper people want to invest in, mutual fund or ETF. What I would say is, from a big picture perspective, you cannot close an ETF. So there are many things that are put in an ETF wrapper that don't have the scale to be lucky enough to be successful. It's not a champagne problem. It's a champagne headache.
Yeah.
And so in order to launch something in ETF, you need to feel as though it has the scale that you will never put yourself in a position of disappointing investors. So what I would say is things that belong in a mutual fund are things that don't have this significant amount of scale from a delivery perspective. And if you think about JEPI, S&P 500 index options, over 1.2 trillion. JEPQ, NASDAQ options, the third most liquid options in the world.
All right, Hamilton, really enjoyed this. Great to catch up with you. That, of course, is Hamilton Rayner, Managing Director and Head of U.S. Equity Derivatives over at JP Morgan Asset Management. Of course, you can catch more of me and all of the ETF action on Wednesday, tomorrow, on ETF IQ at 1 p.m. New York time. But much more coming up on the close. Don't go anywhere. This is Bloomberg.
The more my company grows, the more hats I need to wear. Aon brings their whole team to the table, giving me access to the great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
Will remain the mania behind Messi is helping to drive a surge in Apple TV and MLS streaming subscriptions.
You're just on a last name basis with them?
I don't know. I'm not huge on soccer. But look at those images. Apparently, it was a pretty big deal.
Yeah, I think it's interesting you talk about the MLS season pass that the Apple is offering here. 110,000 new signups just basically after it was announced that he was going to be coming to the U.S. and play here. That's pretty good, I would think, right?
Yeah, we'll see what this means for soccer long term, whether we're going to talk about this in the same breath as football, as baseball, as basketball, but not a bad start.
We already are. I mean, we go back. I mean, I'm going to date myself, but you go back to Pele, the Brazilian star, coming to the U.S. and playing with the L.A. team back in the day, and that just created a lot of interest in this. And every so few years, you have one of these big players from Europe come over, Beckham, Messi.
Right. I'm learning a lot.
Who else am I forgetting?
I couldn't tell you.
Who's the French guy who headbutted the other guy?
This is Bloomberg.
My priorities don't just shift, they shift by the hour. That's why I need Aon. Their combination of advanced analytics and expertise helps keep me up to speed and ready for my next move. Better decisions. Aon.
I am the sun.
I am the wind. I am the earth.
I am water. And I am Masdar, a source of hope, pioneering clean energy. And I convert your gifts into opportunities for a greener, cleaner tomorrow. Masdar, pioneering energy.
This is the countdown to the close. About 30 minutes left to go here in the trading session, a mixed day for financial markets.
Not a great start to the trading week. You take a look at the sector level with the S&P 500 under pressure right now. More red than green, as you would expect. Up top, you have energy. It's been a really good day, of course, for oil with that output news. Then you have tech also managing to put together a gain right here. That sector up about 0.5%. Communication services also hanging on. But then you go down the list, and again, more red than green. You take a look at the bottom, utilities, industrials, and then materials bringing up the rear here. Romaine off by 1.7%.
Yeah, a mixed day here for markets. So we should point out some of those big cap names doing their best to keep the market afloat. Tesla having a pretty good day, up about 5%. And keep an eye on Blackstone, up 4%. This after learning that company is going to be included in the S&P 500. I think that starts on September 16th, along with Airbnb here. Some changes now starting to take place in the complexion of that index that maybe potentially changes the complexion of some of the gains and losses. Some earnings still to come a little bit later after the bell, including from Zscaler, the cybersecurity company, up about 2%, and Asana, which is kind of like task software, that's down about 0.9%. Those earnings will come after the bell tonight. But of course, we have to talk about, well, what else? NVIDIA. It's basically been the star of the show, not only today, not only for the week, the month, but quite frankly, for the year. Sitting right now on a 233% gain on a year-to-date basis. That would, if those gains hold through December, that would be the best yearly performance for NVIDIA going back to at least 2001 here. And more importantly, a stock that has now started to close the cap with some of those other trillion-dollar behemoths. But of course, Katie, when you start to take a look at some of those multiples, some of those valuations, just remember, you're paying about 100 times current earnings, on NVIDIA right now on a current basis, and about 45 times earnings looking forward.
Yeah, so some lofty valuations, if you will, there. Let's stick with NVIDIA here. Talk about really the market's hype for artificial intelligence. We're going to do that with Rob Arnott. Of course, he is founder and chairman of Research Affiliates, who writes that NVIDIA is, quote, a great company priced beyond perfection. And Rob, you also write that NVIDIA is a textbook story of a big market delusion. What's the delusion here? Is it that AI is too good to be true?
Not at all. I'm reminded so much of the dot-com bubble of 2000. The narrative was the internet's going to change everything. It'll change the way we communicate, the way we get our news, the way we socially interact, the way we buy and sell goods and services, and the list goes on. The narrative was absolutely correct. The pricing was wrong. The identification of who the winners would be 10 years hence was wrong. Apple was ranked 30th largest market cap tech stock, not even in the top 100 of companies in market cap at the peak of the tech bubble in 2000, and turned out to rise 16,000%, 160-fold. So it was missed. The one out of the top 10 names in market cap among the tech darlings of 2000, the one and only one that was ahead by the end of 2022 was Microsoft. 0 out of 10 were ahead by the end of 2017. So you had 18 years in which 0 out of 10 were ahead of the market. That's what a bubble looks like. And it's always dangerous to suggest a bubble while it's happening. It's always nicer to engage in nowcasting, talking about it after it bursts. But the simple fact is this looks an awful lot like 2000, except the narrative now is AI, and the narrative is correct. It's just the prices are wrong.
It's a really interesting point here that if you think about the promise and some of, the more breathless forecasts for AI, it sounds like, again, you're not discounting that. You're not throwing that aside. But when you think to past bubbles around strategies, around companies, around products that have ultimately delivered on those promises, when the prices get out of line like that, what do past examples tell us about how this could go for NVIDIA?
Well, Qualcomm, at the peak of the tech bubble, had risen 27-fold in 1999, the biggest rise of any stock in the world. How's it done since then? Its earnings are up 60-fold in 23 years, 60-fold. And yet it's way behind the S&P 500 because it was priced at 240 times earnings. So price matters. There was a wit in 2000, I forget who it was, who made the quip, these stocks are not just discounting the future, they're discounting the hereafter. And I think we're seeing some of that in this case because AI is real. It's the first technological revolution since the Industrial Revolution that is affecting and endangering jobs of highly skilled, highly educated, highly compensated people for the first time.
One thing that's interesting about that, Robin, no matter who you talk to, whether it's the cheerleaders for this or the naysayers, they all seem to be in the same camp as you on the idea of the narrative, the idea that there is something substantive behind it. One interesting line in your note, though, was this idea here that the beneficiary, I'm just going to quote it, that the main beneficiaries of technological innovation are going to be the customers of that innovation, not necessarily the innovators themselves. That really stood out to me.
Thank you. Thank you for noticing that comment. One of the beauties of capitalism is in order to succeed, you have to have happy customers. In order to thrive, you have to have thrilled customers. And in order to profit, you have to have people willing to pay your price for your goods and services, which basically means they have to like it more than the price in order to buy it. And happy customers make for a successful business. AI has been around forever. I used neural networks in the late 80s in stock selection, not with any particular success. There wasn't enough data. But AI is enormously data hungry. If you have millions of pieces of data, it's not enough. If you have billions or trillions, now you're talking. And so AI is going to change everything. But as with any technological revolution, the millions of jobs that are displaced, there will be millions of jobs created also. And a generation from now, not one of the jobs that's lost to AI will be missed.
Is it hard for you as an investor? Is it hard to sort of find, I guess, those potential winners longer term, right? Because as you pointed out in your note, I mean, some of us are old enough where we were carrying around BlackBerries and that was the hot, innovative thing. Everybody thought this was a game changer, and it was. I don't know anyone who's carrying a BlackBerry right now. It was a game changer. They set a standard, but that standard, that mantle was picked up by eventually Apple and then eventually Google with its Android.
Yeah. Palm was worth more than General Motors in 2000, ever so briefly. And it was displaced by the BlackBerry, which was displaced by the iPhone. Things change. And the narrative is that the organizations that are so well funded and so have so much expertise on AI will be the winners. The notion of big market delusion is that you have an enormous market potential in the future, and the players today will be the winners. They're all priced as if they're going to win. Never mind the fact that some of them, that they're competing against one another, so they can't all win, and there will be some upstarts along the way. There was an internal memo at Google that leaked where an executive at Google was saying, we have no moat, nor does NVIDIA.
All right, Rob, we got to leave it there. Really enjoyed this conversation. Hope to have you back soon. That is Rob Arnott, founder and chairman of Research Affiliates. Now, coming up on the close, United Airlines shares whipsawing after a temporary grounding of its aircraft. It's our Stock of the Hour coming up next. This is Bloomberg.
It seems more and more high-stakes decisions are ending up in my hands. Aon's advanced analytics and expert insights put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.